Hi everybody and welcome to ABG Investor Day. My name is Patrik Brattelius and I'm an equity analyst here at ABG. Today we have a full day ahead of us with a bunch of companies presenting. It's my pleasure to introduce the CEO of Cameo Sweden, Fredrik Kjellgren. He will be our first speaker today. Take it away, Fredrik.
Perfect. Thank you very much, Patrick. And I feel really good to be here today. So I'm really excited about this session. So I'm here today to talk about Cameo and what we do, why we do what we do, and how it works. I would also like to spend some time on discussing our performance to date, and specifically around our performance as Cameo as an investment alternative. And last but not least, I would like to share some insights from the market. So how are we at Cameo, and more importantly, how are our borrowers responding to the new market conditions that are out there? So that's the plan for today. So I hope you will find this session interesting. But let's get started. So Cameo, what do we do? So our concept is fairly simple. So we operate a platform and a community, enabling the pooling of small contributions of money from a group of people or companies who share a common interest in order to accomplish great things. So we empower everyone to really achieve their own financial goals. So that's what we do. And if we take this a little bit step further, so really what we do is that we match companies who has a financial need. They maybe need financing to build a project or to realize a growth initiatives with investors who like to invest in those companies or projects. And companies, they turn to us because we can offer a competitive financial solutions for their project or growth initiatives. And investors, they come to us because we can offer asset-backed loans with high expected returns. And this is really simple, and this is the model that we operate in. And this is how it looks like. So I'm not sure if you have seen this, been on Cameo before, but it's if you as an investor would like to invest in loans, you will then go to our platform. You would choose which project you're interested in, and you would read the materials and the prospect for that loan. And if it's something that interests you, you will then choose to invest. So it's your choice as an investor what you would like to invest in. And we at Cameo, we put a lot of effort into what we do. And we do this because we truly believe that everyone, regardless if you have a big network or not, you should have the opportunity to invest in products that matters. So what we do in Cameo is really that we are opening up the financial markets, and specifically the private debt market, to more individuals. So that's what we do. So we are truly believe that this is something that should be available for everyone. That's the cause. So how does it work then? So we have been in the business since 2016. We provide financing solutions primarily to real estate projects. I would say close to 80 to 85% of the loans that we have facilitated during the last 6 years has been within the real estate sector. And as you can see on this slide, is typical projects that we fund. And to the left is a typical residential projects that we tend to fund. And these are normally a property developer that would like to build around 10 to 30 units with a funding need of between 20 to 100 million. Usually these projects are located in the major cities around Scandinavia, so that is Stockholm, Gothenburg, Malmö, Copenhagen, and Oslo. We also do a couple of industrial properties as well, as you can see in the middle. And these projects also tend to be located around the major cities in the major cities in Scandinavia. We have also done a couple of holiday homes. They tend typically to be located around the major ski resorts in Sweden and Norway. And typically for all these projects is that the interest rate for an investor spans between 7 to 10%, and with a maturity from 6 to 24 months. So that's the typical projects that we do. And our process, so not everyone, we will not publish every loan on the platform, quite opposite. So we spend a lot of time assessing every single case that we publish on the platform. And our credit process is really split into 3 key steps. And the first step is if someone comes to us, or if someone is recommending Cameo as a financial partner, we will meet them with them. And often we will visit their on-site to really understand the project. And if it's a good fit, both for us as Cameo, our investors, and also, of course, for the borrower, because it needs to be a good fit for both. And if we believe that this is a good fit, one of our credit analysts will take lead, and we spend roughly between 30 to 40 hours per case. And if we still believe that this is a good fit for us and our investors, we will then present this to our credit committee. And the credit committee consists both of internal people at Cameo, but also external experts that we bring in to really to ensure that we really can assess the risks and the opportunity in each of these projects. And if it's still a good case and it works, we will then publish it on our platform. And as you will see when you enter our site, we tend to divide project into tranches. And for us, this is a really important concept because we can therefore match the project phases with funding. And for us, this creates a great opportunity to control and mitigate risks. For instance, if you need 5 million to do groundwork for a project, we would like to see that the groundwork has been completed before releasing the subsequent tranche. And for the borrower, this is also good because it reduces the financial cost of the project. And for investors, this also creates an opportunity for you to invest in the phases where you feel most comfortable in. So for instance, if you're an investor that likes to be involved early with slightly higher interest rates and longer duration, then maybe the first tranches of a project is for you. But if you, on the other hand, is an investor that prefer to invest later in the stage of the project, where most of the houses, if the house real estate project, has been built, then maybe the last tranches would be for you. So that's the way how we work within Cameo. And an important concept that we also run, and it goes through back to the purpose of why we do what we do, is that through Cameo you can invest from 500 kronor and upwards. So for us, this is really a way to reduce the barriers to build a well-diversified lending portfolio. And it also makes it easier for you as an investor to reinvest the interest proceeds that you get from the loans that we do. Also within Cameo, and here I think we are quite unique in the marketplace, is that every single loan that we do comes with a monthly coupon payment. So that means that if you invest in a loan, you will collect an interest payment every single month for that loan. And this chart that I present here illustrates what that looks like. So this is the number of interest payments for a typical month that we proceed within Cameo. And as you can see, more or less every single day we process an interest payment. So that means that if you invest in a portfolio of loans, it's likely that you will collect an interest payment more or less every single day via our platform. And the average investor today has invested in on average 15 loans. So that means every second day, the average investor would collect an interest payment. So this is a product that tends to appeal to those investors who likes passive income or like to invest in assets that yields a constant cash flow. Cool. So how has it gone? This is a key question, I think, if you would like to invest in a platform like ours. So Cameo was founded in 2014. We did the first loan in May 2016. And on this chart here, you can see the volume growth we have seen during the last 6 years. And as of today, we have facilitated loans for more than 2.6 billion kronor. And as you can also see on this chart is that the growth has really picked up during the last 3 years. And this is really, my view on this is that we're starting to see that direct lending, which is what we do, you don't invest in Cameo, you lend money directly to a company, is starting to be seen as a normal way of funding your products, which is great, I think. From an investor point of view, we have the average return has been between 8 to 10% per year. And you can also see that the return has slightly decreased during the last 3 years. And that's really because as we have grown, we have been able to work with larger companies and larger projects. And the market rate for those projects tend to be slightly lower than for smaller projects with smaller developers or less experienced developers. So this is reflecting, I think, the growth journey that we at Cameo has been through. But I also think that this is really interesting to put this number in perspective. So what does between 8 to 10% actually mean? So on this slide here, I'll try to illustrate this. So what you can see here is the dark blue line is Cameo. So that is if you had invested constantly through our platform and receiving between 8 to 10%, this is where you would then have ending up with somewhere between the green and light blue lines, which is popular high yields funds, and the pink line, which is the OMX All Share Index. If you would have been a very conservative investor and invested in a money market fund, you would have been slightly worse off after 6 years. I think the money market funds are down to 2% as of today. So for me, this is also signals that investing in direct lending, so lend directly to a company, I think my personal view is that this should be part of a well-balanced investment portfolio. So in short, the track record we have seen since the start is investors have the average return on the loans we have provided on the platform has been 8.6% since the start after credit losses. We have published 626 loans with a total volume of 2.6 billion. Out of this 2.6 billion, 1.3 billion has been repaid. And out of these 626 loans, we have had 6 loans that has gone into default. And we only do asset-backed loans, which means that if a loan goes into default, we as Cameo will act as an agent on behalf of our investors and start realizing those assets. And for 4 out of these 6, investors have received 100% repayments, plus interest and plus penalty interest on top of that. And we have 2 loans, 2 Norwegian loans, totaling 4.3 million that we have confirmed as credit losses. So in total, the credit loss is less than 0.2% since the start of 2016. All right. Lastly, I would like also to take the opportunity here to talk a little bit of the market situation. So what happens when interest rates are rising, and also how are borrowers and property developers responding to new market conditions? And first of all, I think talking about interest rates, we at Cameo, we are operating in a quite competitive market. So we don't really determine what's a market rate. So in more or less every single case that we are evaluating, we are in competition with some other actors. And that can be credit institutions, it could be small and niche banks, and in some cases even large banks. So the interest rate we put on the loan reflects more or less what the market rate is for those loans. And now we're talking about real estate projects up to 150 million, less than a loan to value of 75%. So if the interest rate is going up in general, it's likely to also to anticipate that the interest rate on our loan will increase as well. But then we have, it's not just interest rate that is currently rising. We also see quite substantial material cost for materials as well, and some other disturbances, if you like to call it that. So we at Cameo, we spend a lot of time assessing new credit. As I said in the beginning, credit analysts spend at least 40 hours on a case. But I would say we spend even more time monitoring live loans in our live loan portfolio. And that is loans that we have published on the platform, but which has not yet been repaid. And as part of these dialogues, we have identified a couple of emergent risks or themes of risks that we see that we would like to share with you. And the first, which I think all of you is aware of, is inflation and surging material costs is for real. And this is important to know because that can really cause cost overruns and delays in projects. We also see that some of our developers find it difficult to obtain quotations. And more specifically, it's starting to become difficult to secure turnkey contracts. So that is important to know, especially if you're a smaller developer which lacks the competence to run products yourselves. We also see that supply chain starting to be challenging in some parts. Especially we have seen problems with heat pumps not being delivered on time, causing delays. So these are, I would say, new themes that have emerged during the last couple of months. But also, when we talk to our borrowers, they are very aware of these risks, and they are actively working towards mitigating those risks. So what we also see is emerging mitigation themes. We see that many of our borrowers have started to really enhance, to deepen their cooperation with selected contractors. So rather than using many contractors, what we now see is that many work with a couple, and really deepen that relationship as a consequence of, as a response to the new external environment. We also see that many of our borrowers are more open towards to using more sourcing alternatives. That could be, for instance, that in the past you could have been very close to a certain brand, but today that doesn't really matter as much. You're more open to use different products and different sourcing routes for your product. We also see that borrowers build stock and ensure that they have critical components on site before they actually start their production. And we see that fewer are accepting fixed-term contracts. And that's really because fixed-term contracts has become really expensive. So, which is understandable because The contract needs to absorb cost and an uncertainty, but many developers now run these products in-house instead. And we also see that developers are planning for and using a higher contingency buffer, i.e. there are more flexibility in their budget for their project. And we as Cameo, of course, we also monitoring this very hands-on. So for all new products, we will assess even more thoroughly the construction part in a case. So how is the contractor, how is the subcontractors look like, etc. And we will also like to see higher contingency buffer in any projects that we do. So I think I'm running out of time, but in short then, so Cameo, we are a leading Scandinavian lending platform for asset-backed loans. So we enable for everyone, so that is private and corporate investors, to lend money directly to companies. We believe that we can offer a good complement to your savings portfolio, and via Cameo you can invest from 500 kronor and then upwards. And if you find this interesting and you would like to get started, which I hope some of you would like, please visit cameo.se and register an account and get started. So with that, I would really to say thank you for hosting this event, and thank you for listening to me.
Thank you, Fredrik. So then I thought we could do some Q&A. So if I start off, on the platform, does your customer have access to an ISK, investment savings account, or how does the account setup look like?
That's a really good question. So unfortunately today in Sweden, direct lending is not supported by this ISK. And that has really to do with regulatory, that's the rules. So in Cameo today, you lend money directly to a company, but the rules today do not allow you to put that into a savings account, unfortunately.
Okay, and do you have any status update on when that could be accepted, or is that not even planned for by the regulators at this point?
No, it's not what we heard planned for, but it's of course something that we would like to see, because I think if you can invest in both crypto and everything else in putting a savings account, I think direct lending should definitely also be an asset class that you should be able to have in a savings account. But unfortunately not. That's the answer.
Okay. How does the Nordic market look in comparison to other markets when it comes to maturity? Is the Nordic market immature in that sense, and other markets has come further? What steps need to occur in the Nordic market to become a more common phenomenon?
Yeah, that's an excellent question. So Sweden, Norway, and I would say most of the Scandinavian countries have traditionally been a big bank market. So in other parts of the world, especially in the UK, for instance, direct lending and alternative finance, if you like, it's much bigger. And now we're starting to see that this trend is also picking up in the Scandinavian countries. So we are a little bit behind other primarily European markets with regards to direct lending, but we see that the shift is happening. And I think the reason for that is both companies see that this really works. There's nothing strange to have an investor to lend money directly to you. And I think investors also see that this is an opportunity to get high-yielding products, really. So the short answer is we are a little bit behind, but the trend is working in our favor, I would say.
Okay, perfect. The time is running out, so I will stop here, and I would like to thank Fredrik for this presentation, and thank you so much for listening in.
Thank you.
Hi, welcome to this presentation with ECIT. My name is Eirik Tunerisland and I'm an analyst with ABG. With me today I have the CEO Peter Lauring, CFO Mats Skogård, partner of the IT division Mikkel Valde, and IR is Linn Paulsen. They will give us a 20 minutes presentation and we will round off with some questions after that. So with that I give the word over to you.
Thank you, Eric. My name is Peter Lauring. We will tell a little bit about ECIT, the business we are building, the services we are offering to our customers, how we have done the financial performance the last couple of years and the last quarter, our financial targets, a little about financial targets going forward, and something about why ECIT could be an interest company to have a share in. With that, first, a little bit about ECIT. ECIT was founded in 2013. It has since that been built on an acquisition model where we are acquiring a part of a company in order to make the entrepreneurs who actually is running the company when ECIT meets them to be part of both building the company going forward as well as building ECIT. We have done around 125 acquisitions since the very start, and due to our model, we have 250 what we call operative partners, meaning for entrepreneurs who are owning shares in the local subsidiaries as well as shares in ECIT. ECIT is a people business with more than 2,200 employees. ECIT present in 10 countries with the majority of the customer base in Scandinavia and two quite large nearshore capacity bases in Lithuania and in Poland. And through providing accounting services as well as IT services to our customers, we aim to be a strategic partner. And since this is the two largest posters in most companies' admin budgets. If we look at the offerings, ECIT has a large F&A division providing finance and accounting services, payroll and HR, and a little debt collection, only in Norway actually, but on payroll and finance and accounting doing quite a large spectrum of services. On the IT services and support side, we provide IT security, IT operation, managed services, and data centers. We have several data centers hosting ASP and hybrid cloud solutions, as well as we have the local device management where we are operating the workplace for many of our customers. Besides that, we have a department for division for digitalization solutions where we are delivering customized ERP, CRM, payroll solutions for our customers, both ECIT products as well as third-party products, Microsoft, Visma, and Jeeves and the like. On top of the two divisions, we have a small tech software division who is providing a business suite mainly aimed for our SMB customers, ERP, digital invoice handling, ERP system, payroll system, logistics, travel, time and material, mileage, and many other offerings. But basic is like we combine finance and accounting services with IT services and are strong in the corner point where those two activities meet each other. And then we support it by gradually building our own product suite of IEC IT tech aimed mainly at our accounting customers. ECIT has over the time developed what we call a standard process on how to acquire and integrate a company into becoming part of ECIT. It's quite important that even though we have made 125 acquisitions, we are building a group. We are not building a group of companies. And the process we gradually have developed is that we are making an acquisition as the first step. Then we made the companies to relocate to larger sites where they can sit together. Sitting there, they normally or as a normal process starts to cooperate and gradually to integrate, and that process ends very often with that they merge to form a larger company, and also sitting together in a multi-competence environment makes that we are forming a much more attractive environment for our employees, as well as a visible, much more strong, capable environment for our customers. Looking into how we build the business based on acquisitions, but gradually are building a group that is consolidated, is that we have an approach where we do not uniform our entrepreneurs in new companies to become part of the ECIT way from the very beginning, but we accept that this is a gradual process where they gradually adhere to, align to, become part of ECIT and part of the ECIT standards that we are developing. And they are in that process able to affect the standards then on how we are building, on which we are building ECIT, meaning there's a buy-in from coming from the outside, having your own picture of how you should build a business, and to gradually become part of how we in ECIT are building a business. That keeps the entrepreneurs on board with ECIT, which is quite important. If we look at the financial performance, we have an historical, we started at 0 in 2013. We have had a gradual build up on the business from day one, and we have actually also produced a positive EBITDA in all the years we've been operating. Coming out of 2021 with a 2.4 million revenue and a 339 million EBITDA, or 14.2%. And if we look at how that EBITDA has transferred to cash flow, it's like we have had a growth in revenue from 20 to 21 at 30%. We have had a growth in EBITDA from 20 to 21 at 32%, and the growth in our free cash flow have increased by 35%, actually meaning that we are transforming revenue growth to earnings growth and actually to growth in the free cash flow as well. A large part, close to 71% of our revenue is very repeatable, or it's based on recurring contracts. And if we look, so we have quite a stable revenue going forward, and we are actually in the process of gradually changing our time and material historical, where we're coming from historical into contracts that where we have a fixed amount or transaction pricing behind the customer relationship or the customer deliveries, meaning we are working gradually to make our revenue more stable for the years to come. Looking at earnings per share, we have increased from 3 years per share in 19 to 13 years per share in 2021. And if you take a little comment on the business segments, the 3 divisions, we have an F&A division that has increased the revenue from 843 to 1298 in 19 to 1298 in 2021, with a 225 million EBITDA or 17.3%. And if you take the IT division, it's from 553, 19 to 1.1 billion 2021, with a 12.7% margin, 140 million in EBITDA. And the tech division that is gradually building up from almost or from 0, it's increasing from 29 million to 104 million in 2021, We are investing in that division, and we'll do that for a couple of years going forward. So it'll take a year or two before we will see some attractive EBITDA. But we can see we gradually are coming there, and that some of the companies, some of the products gradually are transforming from just be cash outflow to actually create some EBITDA. On how to drive the revenue in these divisions, we have quite a good organic fundament in the ability to cross-sell. We have a customer base at more than 50,000 customers, so the potential for cross-sell or upsell is quite large. It takes a week or two to make the organization to adjust to be able to cross-sell, because you actually have to be able to make sure that the customer are happy on the other side. So it's something it's a super interesting potential, but it takes some time to actually realize the potential. And then, of course, attract new customers and customer retention. We work quite strongly with NPS, getting better at it over the years, actually. And then, of course, which have formed the ECIT part acquisitions. We have been doing between 8 to 20 acquisitions a year over the last, actually since we started ECIT, and we aim to continue to do acquisitions in that way. On the margin, the consolidation process and aligning to the ECIT way is by far the largest driver to improve EBITDA, and we can see it comes as we are forming a core body in ECIT, we become stronger in that area. But also that is a process that takes a week or two. Also because we have many employees we are working with to actually be able to have the same deliveries, the same notions, the same way of acting, the same contracts, the same everything when we are facing our customers. Nearshoring is part of where we gain EBITDA margin as well as cost synergies. But the by far most important part here is to build one company out of the many companies we have acquired. Looking at financial performance just for the recent quarter Q1, we came out of the quarter with 710 million in revenue and 87 million in EBITDA, which is a 28% revenue growth and a 12.3% margin, a little increase compared to the 11.9% we had the same quarter last year. And as well here, a 32% EBITDA growth measured quarter over quarter has translated into a 35% growth measured quarter over quarter in the free cash flow. On the acquisitions, we have done 2 in Q1 22. One is Exact Accounting with a revenue around 50 million and an 80% EBITDA margin. It's actually the old KPMG accounting in Norway, and we consider it quite interesting for 3 reasons. One is they are very capable on the large account segments where we actually acquired Nordic last year and see those 2 companies to act together going forward. The other thing is that it had a very strong ex-ledger environment, which in combination with the same ex-ledger environment in Nordic actually can form a quite strong ex-ledger business going forward. We will become one of the largest ex-ledger partners in Norway. And Exact as well had a quite strong Microsoft environment, whereas Microsoft is not so much known in Norway. That is mainly Visma country, but Microsoft is growing. So having gaining a team that's working focused on Microsoft products is a thing that we expect to to experience growth based on the strengths coming from this team. As well, we have acquired a company called CataCloud with an ERP solution aimed for SMB customers, and we expect with that product that we are able to implement it on 12 to 14,000 on our present customer base within, say, between the coming 1 to 3 years. It takes a week or two there as well to make such a large change. But having the product is giving us the possibility to actually gradually switch to ECIT-based technology on our account counting production. If we look at our mid to long-term ambitions, we actually have quite a strong growth ambition. Totally, we expect to grow 15%. If you look at us in 5 years' time and look back, we should have had a total growth at least 15% per year. And we are including in that a target for 5.5% growth, organic every year. We aim to deliver an EBITDA margin at 17% compared to the 14.2 we had in 2021. And we also aim to continue to do acquisitions at a level around 350 million NOK in revenue per year going forward. And to add to that comment is to say we for now have a larger pipeline of acquisition targets than we have ever had before, as well as that the quality of the objects in this pipeline is getting more and more interested. It's very visible for us that as we are gaining size and becoming a little known, that more and more quality companies would like to actually meet us and consider to becoming a part of ECIT. All in all, if you look at ECIT from the outside, we are operating on 2 large markets. One is the F&A market with around 100 billion in total revenue in the Nordics, and the other is the IT market with around 500 billion market size in the Nordics. Both markets is something that all companies need, whether it's tough financial conditions in society or whether it's good conditions. You always need accounting, F&A, and payroll. You always need your IT services, whether how conditions are. So we have quite a stable fundament for our revenue. Our services and offerings towards our customers are strong in the cross point of where accounting meets IT, and we are coming from, as the accounting services are getting more and more digitalized, more and more automated, to become part of that development is part of how we see ECIT it will be important and will have a competitive place in the markets going forward. We have a large customer base with more than 50,000 customers and increasing. We have an organization that keep the entrepreneurs that have originally joined ECIT from acquisitions, keep their spirit, keep their drive, they want to build a business together with a quite experienced management team. It's for several of us who are in the management team. It's the 3rd time we are building a business like this. ECIT has quite a growth potential from up and cross-selling to this large customer base, and also quite some margin potential coming from that we are gradually aligning, consolidating, and implementing how we are doing things in ECIT, doing them, so to speak, in the ECIT way. And then we hope that we have demonstrated that we are able to actually buy a company or buy part of a company and gradually transform it to become part of an ECIT organization and an ECIT group. And as we have a strong pipeline, we expect that buy strategy to continue for the years we can see in for the coming years. So with that, I think I'm through my presentation and we are ready for questions, if there should be any.
Thank you, Peter. as you become larger, it is natural that you will start to look at larger M&A opportunities, and you touched slightly upon this, but can you shed some light on how your M&A strategy has developed recently and what kind of acquisitions you are looking to do going forward?
We can see that we are meeting companies who on one side are larger and for that reason also have a more professional owners, meaning that we are increasingly meeting companies where there are financial investors, and with them we cannot use this in the same way our traditional we are buying a part of a company. So what we do is we buy a much larger part of a company, or we acquire 100%, and then we sell something of what we have acquired, the shares we have acquired, back to the management to actually incentivize them to have the drive to build the business going forward according to our model. And in the lower end of the smaller companies, so to speak, we can see that companies that wouldn't talk with us 5-7 years back, quality companies actually look at us now and say, maybe it could be interesting to hear what you can offer us. So we get more qualified. We have a more qualified pipeline, meeting more qualified companies on a regular basis.
So a larger share of ownership and larger companies as well going forward, I assume.
Without leaving the smaller companies, but I think the smaller companies have a little higher competence profile than the ones we acquired 8 years back.
Yeah, and in the nature of being an M&A compounder, margins are obviously affected when you do acquisitions. So can you also say something about the underlying margins that you're seeing in each segment and how they have developed recently?
I can say it like this: we have made 2 larger acquisitions in the 3 larger acquisitions actually in the F&A area. 2 years within the last 2 years. A company called Från in Sweden, who actually came to us with a negative EBITDA, now delivering a quite nice, at least in comparison, positive EBITDA. We acquired Moderne Økonomi, which we gradually are affecting also to deliver better. We acquired Nordic, who is quite a new acquisition still in the terms of that is the largest acquisition we have done so far. But they all are gradually improving their margins as they are becoming a part of ECIT. In the IT division, we can see we are just in the middle of 3 large mergers affecting the IT division. But we can see whenever we have made these mergers that within half a year, 12 months, 18 months after that, the company are coming out stronger with a better margin, with a better fundament for organic growth, and actually are able to meet a larger customer segment. So we expect the margin in the IT division coming out of the mergers gradually to improve. And it's exactly the same in the accounting division. On the software division, I expect, as I mentioned, that it will take a year or 2 before we will see a super positive margin there, because we are building more than we are harvesting, so to speak, where we are right now.
Yeah, interesting. And you also mentioned the cross-selling potential, but can you say something about how many customers that are both involved in F&A and IT, or are there sort of any cross-selling potential that you can quantify?
Well, I think, Mikkel, you are actually able to better answer that than me, because it's not only cross-sale F&A and IT, it's also internal IT to IT. Mikkel, could you shed some light here, please?
Yes, the cross-selling, I would say, is a relatively low number of customers, partly because it's not common. It's not many places where you can actually source both F&A and IT combined from one supplier or vendor. So the customer will need to realize that we can actually provide both of these areas from one provider. So that's one thing, and then it's something that we are working very hard on making a model for increasing cross sells, and it's starting to roll and it's starting to pick up speed. And I think the numbers will definitely increase for the following years now that we have a structure, sort of a structure in place. So relatively low, very high potential.
Yeah. Could I add to that we have a target internal that it says we should generate 3.5% of our total revenue should come from cross sales, and I think we from the poor registrations we're able to track from our because we are also building a shared service center, meaning now we have 80 different local bookie or balance sheets to look into, and we are over the next year transforming them to be all delivered from one shared service center. So we will know this better, but I say around 2.5% of our revenue growth are coming from cross sales where we are right now.
Yeah, sounds interesting. I think we are out of time now, but thank you for taking the time to present to us today. And for those who listened in, thank you as well.
Thank you for your time and attention. And Iselin, you want to say something?
Not really prepared, but would just like to add that the cross-sales potential that Mikkel and Peter just spoke about is increasing in the Nordic countries, especially within the IT section.
Thank you. That's all for us.
Thank you.
Cheers.
Hello everyone and welcome to this presentation with Explora Technologies. My name is Øystein Lodgaard. I'm an equity research analyst here at ABG, and with us today we have both the CEO of Explora, Sten Kirkbak, and the CFO, Mikael Clement. They'll take us through a brief presentation and then we'll do some Q&A afterwards. So Sten, the floor is yours.
Thank you so much, Øystein. My name is Sten, founder and CEO of Explora, and with me today, Mikael Clement, our CFO, as mentioned, and we'll take you through this presentation today. Let's go straight into it, and we can just go to the next page. So, what is Explora? Explora is a category leader in a large and growing market for smartwatches for kids. It's a huge and untapped market. It's highly scalable, and we have a business model that gives us recurring service revenue per month. And as you can see, we have started hugely successful within the Nordic market in particular, and now ready to scale this business into the global market in Europe and US. And also some facts about the company. We have already launched and successfully had into the market 7th generation of our products. We have sold more than 700,000 watches already, and our product is being distributed by more than 20 different markets. And we're also a listed company at Euronext Growth. That is a high level of the company. If you go to the next page, I will take you through how we are selling and positioning this product. And the very important thing to understand is Explora, we are addressing 2 very important pain points for most parents. Number one, most parents, even if they have kids younger than when you typically will buy them a smartphone, you would really like as a parent to be able to reach out to your kids. That's pain point number 1. Pain point number 2, our product also incentivizes kids to be more active. For that reason, we are positioning our product as your child's first mobile phone, addressing the peace of mind element to most parents. Our target group is kids from 4 to 10 years old. Also, it's important to understand some of the key features of our product is that the parent can do all the setup and control every single feature of the kid's smartwatch. From the parental app, you have 5 key features. 1, you can set up your dial list, your phone list, and only the numbers that you're setting into that phone book will be allowed to call the watch, and the watch can only call those numbers. So even if you have the child's phone number and you're not in that list, you would not be able to reach the child. It will be blocked by our platform. The second feature is that the same numbers can also send text messages to the watch, and the watch can reply with text messages back. A third feature, very important for this proposition, is that the parents are allowed to see the child's location in the map in the parental app, meaning that if the parents wonder where the kids are, you can then look into the parental app and you can see the location. Within that feature, you can also then set up a safe zone, allowing the parents to be notified if the kids are entering a zone or exiting a zone. For example, when the kids arrive to school or arrives back home safely. And also, if needed, the child are able to push one button, activating an SOS feature, making it possible to immediately reach out and contact everyone on that phone book, on that contact list. So that's a 5 key feature for the peace of mind and contact functionality. Then we have also emphasized the step counter within the watch, allowing us to build many features and services promoting healthy and an active lifestyle, incentivizing and encouraging kids to be more active with our Go Play services, which I will come back to. So that's a key proposition, addressing those 2 pain points, being able to contact your kids and incentivizing kids to be more active. On the next page, you will see our IP strategy. And from day 1, we design our IP strategy based on 4 different building blocks. Number one, we started by developing our GDPR-compliant family IoT platform. That's a hardware-agnostic platform allowing a parental app or an application to contact an IoT product, a sensor. In our case, a smartwatch for kids. So the first piece of IP in the company is our GDPR-compliant family IoT platform. Then, as mentioned, we have successfully launched 7 different products into the market, and we also recently have made a change from a traditional ODM to an OEM hardware platform. That means that our product that we are launching this year into the market, we own all the stack of IP, design the product from scratch ourselves, owning every single IP of that product. This year, we are launching 3 new products. 2 of those new products is our new OEM product. The third piece of our IP strategy is our Explora Connect service. Last year, we acquired our mobile distributor in the Nordic market, Explora Mobile, which is the MVNO. That means that in the Nordic market previously, Explora was bundled with a SIM subscription, allowing to have a very compelling value proposition, both with product and recurring service revenue. And a strategy for that acquisition is to take all that competence from an MVNO company and replicate that business model into the global market. And the last piece in our IP strategy is our Explora GoPlay services, because our service revenue strategy has been to introduce product, the smartwatches, add SIM recurring revenue from the MVNO, and on top of that, potentially add new recurring service revenue. So the IP strategy is laid out based on these 4 building blocks. On the next page, I will give you an example of some of the services we are planning to introduce in the market and has already been introduced in the market. And one of the key reasons for building a strong service platform and offering is to create more stickiness as well as a potential future revenue stream. Because as I mentioned initially, the core value proposition was peace of mind to the parent. The parent is buying this product in order to give them peace of mind by knowing they can, every time they would like to, reach their kid in any situation. But in order to also add a very strong value proposition to the kids, so the kids would like to take on the watch and use it every single day, it's important to also have a strong service proposition with services and application the kid love to use. For that reason, we have over the last couple of years been able to work with some of the world's largest leading entertainment companies, such as Disney, Sony, and Warner, to create great content. And now we are facilitating and structuring all that content with the objective to launch new services and also premium services later this year. Some of the samples and the reason behind our service strategy. On the next page, I will take you through how we are monetizing on these various applications and features. Going back when we got listed and previously, Explora had the revenue primarily from smartwatches plus accessory. We sold our watches online through retail and selected telco channels, primarily getting the revenue from our watches with accessory. Now, after the acquisition of the Nordic MVNO and our distributor, we also have introduced revenue streams from our own SIM subscription, Explora Connect. That's a highly profitable and scalable service business model. And the strategy going forward is to replicate the same model into new market and into the global market. And the future way of monetizing our business model is then to add additional service revenue on top of the SIM subscription. And the beauty with our business model, since the product, the smartwatches, is a mobile device, you have to have a SIM card. It's not optionally. Every single product needs to have a SIM card. For that reason, it was natural for us to go into the MVNO route and bundle our own SIM cards in every single watch that we are selling. And then on top of that, the customer in the future will then also be allowed to have this opportunity to potentially upgrade further to new services and new premium and value-added content. That's a high level of our monetization strategy. And to give you a quick overview on how successfully this business model have been, on the next page, you can see the status quo from the Nordic market. So of all the kids in the age group 4 to 10, every single kid in that age group, almost 1 out of 5 have in the Norwegian market a product from Explora with an Explora SIM connected to it. So 17% market penetration of all kids from 4 to 10 use an Explora product with an Explora service in the Norwegian market. And now we're replicating that business model into both the Nordic and to the global market. Following up the next couple of pages, Michael will then guide you through some of the financial highlights.
Thank you, Stan. The company was established in 2016, and as Stan mentioned, the first couple of years the company spent its time to develop the IoT platform and to introduce the first products. Really, the first commercial year was in 2018. And growth in Explora has been very, very strong since then. 2018 revenues, 18 million NOK, has grown 24-fold over the last 4 years to more than 430 million NOK in 2021. Close to 100 million NOK in 2021 revenues came from connectivity services. On the next slide, you can see our geographic footprint. Explora Technologies spent the first few commercial years also to expand into and establish presence in several international markets. In 2021, Germany represented 40% of our revenues, closely followed by Norway at close to 40%, 38%, and then Sweden at 9% of revenues. However, on the different products, the breakdown is a little different. Germany is by far our largest market in terms of device sales, and Explora has a very solid distribution footprint in the German markets, both online through a variety of retailers as well as telcos. Services as of 2021 are from the Nordic markets and through the acquisition of our Nordic partner last year, of which we have the most subscribers in the Norwegian market and the largest share of our service revenues. Close to 3/4, followed by Sweden, where we have a somewhat shorter presence in terms of time than we have in the Norwegian market, followed by Finland and Denmark. Going on to the next slide, as Stan mentioned, we've been through a number of different generations of products and have had a continuous focus on underlying improvements in our gross profitability. We have succeeded in improving the underlying gross profitability over the last few years and growing further in 2021 through the addition of service revenue streams. In large, our sale of devices, we have communicated a target of 30% gross margins on sales of devices, whereas for services, we see significantly higher gross margins in general. So our gross profit base has risen sharply, close to 200 million NOK in 2021, with gross margins closing in the mid-40s. We have, on the next slide, we show the Ebitda generation of the company. Early years investments in market presence, in organization, naturally also in continuous development. 2021 was the first year where we reached a milestone of positive EBITDA earnings, full year earnings, and specifically in the latter parts of the year. On a seasonality basis, we are a company focusing on retail sales, which means that a major share of our sales is in the second half of the year, as with general retail sales around the world. So, Sten, maybe we should look a little ahead in terms of how we plan to grow further.
Yeah. So to summarize our growth strategy and growth plan, also we can divide it into these 3 steps, as you can see on the page. We have always envisioned our hardware, our smartwatches, as the Trojan horse in order to tap into a market, a highly untapped market with a huge demand. And based on these hardware product, we can then introduce new services to then step into the recurring revenue strategy. When it comes to our growth plan of our smartwatches, we will continue to focus the growth in particular in the Nordic region and Germany and the UK market. And of course, and as we have announced, a focus on top of that will also be to focus the launch and growth in the US market. And then, of course, continue to accelerate growth in new market further out in EU as well. Our go-to-market strategy has been unchanged from when we entered and launched the company. We focus on going into new market first with online presence, focusing on Amazon and our own channels. From that point of view, or from having successfully entered in via online, building strong presence with social media marketing, with influencer and a strong review presence, we'll then grow into the retail channels. And then in the third phase, we'll go into the telco channels. We'll continue to use that go-to-market strategy when we're growing our expansion and growth of our smartwatches. As you can see, as number 2 on the screen, you have the Explora SIM connectivity, our own Explora Connect services. After the acquisition of Explora Mobile in the Nordic market, we announced that our goal was to replicate that into new markets in the Europe or US market. Our goal and ambition for 2022 is to replicate that and launch in 1 to 3 new markets as well. So we are growing our distribution and sales of our smartwatches. We have already SIM recurring revenue in the Nordic market, and now with a target to grow into 1 to 3 new markets in Europe or US in 2022. And then the third way of growing the business is to add new and value-added services. And our strategy and timing of these value-added and new services is to add them and align them with the rollout of our SIM services and MVNO value proposition. The reason for that is we see the biggest, or the hypothesis of the biggest conversion into new service sales is at the time when you're buying the product, you have to select the SIM card. We already have the SIM card pre-bundled in every single watch when we're selling that into the market. At the same time, we're also then proposing to the customer to upgrade with value-added and new recurring service revenues. And for that reason, we are aligning our third revenue stream, the Explora Premium Services, and the same rollout plan as when we're introducing our Explora Connect SIM services into the new markets. So our growth plan is to continue to grow our distribution footprint, continue to grow our smartwatch sales, focus on the Nordic market, the German market, and UK market, strong market already today, growing into US and new markets, introduce SIM connectivity in 1 to 3 new markets this year, and align our value-added services and new premium services on the roadmap where we are launching our new SIM MVNO models. That's the growth plan for 2022. And that takes us into the session with Q&A questions.
Thank you very much for a good presentation. So I'd like to start off where you ended off with growth initiatives, and you have guided for growth in 22 of at least 50%. But could you to make this more tangible, could you say something about which key markets you expect to be the biggest growth drivers in 2022?
Very good question, and I think it's fair to say that given the market, given how we see various market and the retailers are evolving, a very important focus for us for this year will be to continue to strengthen our growth in already well-growing markets, such as the Nordic market and also in the German market. The reason for that is that we have such a strong distribution footprint there. We have a very strong brand awareness in these markets, and that also allows us to continue to grow with less risk into those markets. So that's number one. But also, as we have said, and the reason why we announced the first deal as well, the US market will be a market where we'll put a lot of effort into 2022, but still continue with our go-to-market strategy, build online presence, build retail partnership, and then later turn into announcing into or launching into the retailers.
And you also mentioned that you would launch your connectivity services in some new markets. Germany is today the biggest market for you in terms of device sales. Is this a market where we can maybe expect you to also launch your subscription revenues?
I think it's fair to say that our biggest markets, such as UK, US as a market in size, and Germany, will be three natural ways for us to focus. And our ambition is to launch 1, 2, 3. But definitely, those big markets will be our key focus for 2022 to make that happen.
Interesting. And you also recently announced some large online distribution agreements in the US, among others with Walmart. Very exciting. Could you tell us what are your goals for the US market in 2022?
Yeah, I think it's important to just repeat our go-to-market strategy, because we have one of the key things we did all the way from we started was to build a model that we can replicate into new markets without having to change it from market to market. So we'll continue to do the same execution, starting with online. We have to have a solid online presence in social media with influencers, have very strong reviews on Amazon and every single relevant channel for the end consumer. And then in parallel of doing that, we are building agreement with the retailer. So when we feel that the market is mature enough when it comes to our presence, our awareness, our ranking, our review, that is the timing where we get return on investment going into the retail channels, because that comes with investment. And for example, in a market as the US, it's a huge market. We have to have created the groundwork first on online before we start to scale with the retailer. So we'll very carefully replicate our go-to-market strategy, build the online presence while building new distribution contracts. When we feel the market is at the right place, then we start to scale into the retail channels. We'll do the same thing in the US as well.
And last question is, you of course, the kids smartwatch category is a very interesting category. It's still a young category that could sustain growth for many years. But if we think more long term, is it likely that you could also move into other product categories?
I think that's a very good question as well. And that's also the reason why we spend some time today to explaining our IP strategy. And even before we launched our first kids smartwatch product into the market, we actually built our IoT platform with a very clear vision that our IoT platform should be hardware independent or hardware agnostic. The reason for that is that the kids smartwatches is one part of the family IoT category, which could end up being multiple very exciting and compelling categories. What we have seen clearly is that the kids' smartwatches has been the category really leading the way, but with a future expectation that the whole family IoT sector will see a quite significant growth as a whole.
Interesting. Sounds like you're still in the very early days of your growth journey. Thank you very much for presenting to us here today.
Thank you.
Hi everyone and welcome back to ABG's Investor Days. My name is Anna Danfors and I am an equity research analyst in our retail team here at ABG. With me today I have the pleasure of presenting Fiskars Group and CFO Jussi Siitonen and also Investor Relations Director Jussi Essi Lipponen. So we will start off today with a company presentation and then it will be followed by a brief Q&A. So with that being said, please go ahead with your presentation, Jussi.
Thanks. Okay, now hopefully you can hear me. So hello everyone. So in the next 20 minutes, I will walk you through first the group background, what is Fiskars all about, then focusing more on our new strategy. We came up in November last year with the new strategy, including the new financial targets. And then thirdly, I will walk you through our Q1 result and especially full year outlook. So let's move to the next slide. So very shortly, what is Fiskars all about? We are the oldest Finnish company, established 1649. We operate in more than in 30 countries. We are focusing on 3 main segments there. Terra, which is gardening, landscaping. Vita, which is very much tableware, art glass and the likes. And then Crea, which is all about scissors. We operate mainly through wholesalers. Our own D2C, including both e-commerce and own retail, is roughly 20% of sales. We have more than 350 own stores, mainly Iittala branded stores. And last year, we were a bit more than 1.2 billion of sales and 12% EBIT. Let's move to the next slide, which gives you a bit more in detail our brands. So as I said, we have a world-class brand portfolio. You can see here on the first row, our biggest brands there, Fiskars of course, not only the company name, but it's also our main brand. Royal Copenhagen, Iittala, Gerber, Moomin by Arabia, Waterford, Wedgwood, Arabian, Hackman. Those are the big ones, what we have in our portfolio. So we have very strong global portfolio in our hands. On the next slide, please. You can see the categories I already briefly referred. So Vita, which is a bit shy of 50% of our sales, is very much tableware with all brands like Iittala, Waterford, Royal Copenhagen, Wedgwood and Moomin. Also drinkware and interior design is included in this category. Last year, this was highly profitable. We were talking about roughly 15% EBIT for us, and as I said, a bit shy of 50% of sales. Terra, which is very much focused on the US market. USA is the biggest for Terra. That's about gardening, then outdoor both with Fiskars brands and also with Gerber brand, and then watering. And later in this presentation, you will find out that we have actually divested part of our watering business already. This is about the same size with Vita, so roughly 43% of sales, and also at improving profitability quite bad there. The smallest category, Crea, including the famous orange Fiskars scissors and creating tools there, as well as cooking. And this is 14% of our sales. Actually, Crea is our most profitable business, over 20% EBIT margin. So that's very briefly about what this company all about. Then more focusing on our new strategy. And for the context here, for the background, if you go to the next slide, please. Here what you can see is our top line development from the last 4 years there on the left. And as you can see, we had a longish period of no growth. Actually, top line was very flat, even declining somewhat there in 2019. And then it was decided that the new strategy, that needs to be growth strategy. We saw some good growth already in 2021. So top line came up on currency neutral basis 14%, and we have continued that growth track also now in 2022. In the first quarter, we were up 13%. Together with the top line growth, we have also succeeded to improve our gross margin. Gross margin in our businesses is the driving factor of continuous sustainable profitability there. So last year, we succeeded to improve gross margin by 240 basis points there. That's mainly through commercial excellence topics. I will go back to those a bit later. And then also we succeeded to keep our operational expenses quite flattish, leading to the strong improvement there on our EBIT margin. We came up 2.5 points versus the previous year there at 12.3. So that's the background where the company started renewing the strategy in 2021. And then as said, we came out with our new strategy in November last year. And on the next page, you see which are the key factors of our new strategy. As said earlier, this is a growth strategy, meaning that we have a clear strategic focus on growth and different transformational levers what we have. The logic of the new strategy is that we have defined the winning brands what we have. We have 5 winning brands: Fiskars, Iittala, Royal Copenhagen, Gerber, and Moominpie Arabia. So those are the ones where we believe that we still have a lot of growth, but organic growth potential. We also believe that the current profitability level, whilst is good already now, we still have room for improvement in those 5 brands. On winning channels, it's very much our own e-commerce and our own brick and mortar stores. We believe that they will take roughly half of the all growth what we have in the company for the next 4 years until 2025, which is our financial glide path for the future. As said, they are only 20% in our sales at the moment. It's practically all about Vita business. So tableware and all these categories are mainly sold through our own channels there in Vita, whilst own e-commerce, own retail practically does not exist yet in Terra and Crea. In Vita, it's roughly almost half of the business already. On countries, we have defined 2 winning countries, which is US and China. US for the good reason that we already have a strong business there. It's a bit shy of 40% of our total net sales at the moment. And that's still the biggest consumer market, and our brands are well presented in that market. China is another winning country what we have in our portfolio. Strong growth there. Last year we doubled the business. This year first quarter we were up 1.5x versus last year, and it's a market where we have good growth opportunities, especially with Vita brands. Then we have defined 4 transformational levers, and the one where we see that we have the most low-hanging fruit is commercial excellence. This includes everything from price increases, from in-store excellence, both offline and online, and all these kind of, I would say, almost like no-brainers, which company did not have in place in the past. And now when we have started to implement this kind of good commercial excellence practicalities there, we have seen that already now in our gross margin improvement. Direct to consumer, I already mentioned, USA and China. These are the ones where we believe that we have biggest investment opportunities also in the future. And when I'm talking about investment opportunities here, I mean organic investment opportunities. And then we have defined 4 enablers: people, digital, which is the one which is contributing very much to D2C growth, but also commercial excellence there. And that's the one where we have invested most in the past 12-15 months. Innovation and design and sustainability are then the remaining 2 enablers what we have in our portfolio. Then also what we said when we came out with the new strategy last year was that we are now committed to report where we are with these transformational levers. So if you go to the next page, You can see that this is the situation after Q1. So commercial excellence, the above water brands, what we have in our portfolio, we were able to mitigate the negative impacts of cost inflation in 2022. We did that already in 2021, and now we have continued mitigating it after Q1. We had improved gross margin in Q1. I'll get back to that later, explaining also the drivers there. And we believe that on long-term basis, we can continue improving our gross margin. We have set the targets to gross margin that we should be there at 47-48% by 2025, which is our long-term planning horizon at the moment. And currently we are there at 46 plus levels. So we still have roughly 2 percentage point room for improvement in that area. Direct to consumer. So D2C overall was up 14% for Q1, whilst the whole company was 13.5%. And this time it was very much driven by retail. So retail growth was 17% in Q1, and e-commerce, I would say only 7%. There we had some technical setups which was implemented in Q1, and they were not yet fully up and running as we speak. USA, as said, the biggest single country for us, the biggest single market for us as such, up 16% there. And then China, as said, 1.5x in Q1. And even though we have seen those challenges there due to these lockdowns, we see that the underlying demand does exist and it continues. China continues delivering strong growth also for this year. So that's about transformational levers. Then moving to our long-term financial targets, if you go to the next page, please. So together with the new strategy, we also set 4 new financial targets for the company. On net sales, the target is now that we need to deliver organic, FX neutral, mid-single digit growth, quarter after quarter, year after year. And you can see our track record here. So 2020, we were a bit below this kind of mid-single digit level. Last year, over 14% growth. And now if we did trailing 12 months at the end of March, we were over 10% growth. On profitability, the target is set so that EBIT margin, excluding one-offs, should be at mid-teen, roughly 15% by end of 2025. Last year, 2021, we improved with 2.5 points, as I mentioned, and now we have continued improving gross margin. Last 12 months at the end of March was 12.4. It was only, I would say, only 30 basis point down versus respective period year ago. And there our target is to make this roughly 15% by 2025 steadily, so that it's not a hockey stick, that all improvements is coming late in our glide path, but we need to be able to improve it steadily year after year. On cash flow, the target is set free cash flow net profit over 80%, and this has been quite volatile through the past few years, very much working capital related. Currently, we are well below the target for last 12 months trailing, but there are certain reasons mainly relating to our investments in inventories to be able to deliver the second half this year, and I'll get back to that also later. And then balance sheet, we have very strong balance sheet. The targets, how we have set the balance sheet strength is that net debt last 12 months Ebitda must be at or below 2.5x. And as you can see here, we are well below that target. So we do have firepower on our balance sheet for future growth. As said, this is growth strategy and it's organic growth strategy, which means that we are mainly using our balance sheet as well as cash flow to secure our organic growth. But with a balance sheet like this, of course, we need to be mindful that if there are good opportunities in the market for acquisitions, we need to be mindful also with those. But as said, currently we are only focusing on organic growth at the moment. That's very briefly about our strategy and financial targets, then moving to our Q1 result. And if you go to the next slide, some highlights here. So Q1 was our 8th quarter in a row with top-line growth, year-on-year top-line growth. We also continued improving our profitability, mainly through the improved and higher volumes there. And then we kept our outlook unchanged. We are only giving a full year outlook, not quarterly outlook. And what we reconfirmed was that our comparable EBIT will improve from 2021 level. Then on next slide, you can see our quarterly top line improvement, what we have. So top line up 13.5% organically. We have some divestments there earlier this year. So we divested a US watering business, which is very low margin business for us. And excluding that one, you can see how we ended up with this 13.5% top line growth. The growth was highest in our terra category, gardening, landscaping, watering. That was mainly due to the reason that in the US we have a strong selling period in early Q1, when all big retailers there, they built their inventories for the coming season, and of course we were the one benefiting for that inventory build. Next slide shows you our EBIT improvement. Typically, as you can see, Q1 is the strongest period for us, and that's due to our seasonal factors. What we have this year, we continued improving it by over 5 million, and that's pretty much driven by Terra volumes, what I already explained. So that was the main reason there, which continued improving profitability. The next slide, more in detail there about Q1, and a couple of call-outs here. First is gross margin. So gross margin, whilst it was up 190 basis points versus last year, roughly 3/4 of that improvement came from structural changes. So when we succeeded to divest our US watering, which was very low margin business, it immediately improved our gross margin. And most of that improvement, what we had at the group level, came from these divestments. At the same time, we succeeded to mitigate the cost inflation. The cost inflation, what we saw in Q1, was roughly 10%. We talk about 17 million, increase there in cost of goods just due to the input cost inflation. Roughly half of this inflation came from logistic, 1/4 from raw materials, and 1/4 for finished goods. So that was the main structure of this cost inflation. And that's what we succeeded to fully mitigate now in Q1. Then operational expenses up 14 million, out of which roughly one third, 5 million, was those investments what we had in digital capabilities, building up also our own e-commerce there, and then investment in our own retail growth. So those were the biggest investments what we had. Also in Q1, we announced in early March that we are totally walking away from Russia. And we took some one-off due to that one in Q1. So we broke down all the assets what we had in Russia, approximately 10 million there. Russia overall was very small business for us. We talk about roughly 1% of company sales, and we are able to catch that up elsewhere in the markets. So therefore, divesting Russia business totally was not such a big issue for us. Then on Q1 cash flow, a couple of words about this. If you go to the next page, please. So as said, Q1 cash flow is always low. Q1 is always a low cash flow season for us, and this year it was even more negative versus last year due to the fact that we invested in inventories, and then also higher volumes what we had. They went to receivables, and now as we speak, we are repatriating those receivables there. But what we wanted to secure was that we do have availability for the coming seasons, because what we have found out is that retailers, well, consumer is buying what he or she can find on the shelf, and we need to be one who has capabilities to deliver. Then on next page is about balance sheet. So whilst we continued investing in inventories, you can see here roughly 50 million growth on inventories versus last year same period. However, the true number is even higher, because what we need to remember is that we divested US bordering, and there we had 30 million inventories. So organic inventory growth is even higher. At the same time, even though return of capital employed is not our one of our key financial criteria or key financial metrics we are following or setting the targets, you can see that whilst we continue investing in inventories, we also succeeded to improve our capital turnover and capital efficiency overall, and then improve our return on capital employed. The last slide here is about our outlook. I already mentioned that we reconfirmed our full year outlook, so that we expect our EBIT in absolute terms to increase from last year level of 154 million. Having said that, this year will be a bumpy road, so the target is set for full year and we are comfortable with that one. But we see that there's a certain volatility in the market, mainly due to the reasons that the recent inflations what we have seen is somewhat more what we expected for the full year. And the mitigation actions we put in place in February, in March, they start impacting positively on our profitability in the second half this year. So we have somewhat empty period here with those recent actions. When it comes to full year inflation as such, we expected quite high inflation and started to acting accordingly already late last year. So the only addition there is what happened since late February, early March, when the war in Ukraine started and all that kind of implications. So that's something we have recently mitigated. That's very briefly our presentation about Fiskars strategy, financial targets, and then Q1 and full year outlook. I think it's now time for Q&A.
Yes, perfect. Thank you very much, Jussi, for a great presentation. And I'll start off with some few questions here. So touching upon again what you mentioned now in the end regarding volatility in the markets, many companies are experiencing a declining interior interest for the home, and we have also seen a consumer confidence that is at the same bottom levels that we saw in back in April 2020. So how would you say that you are experiencing the demand, and how good is really your visibility ahead?
Yeah, I would say that our visibility to market is not any better than anyone else in this industry. What's good for us is that our portfolio is truly global, and it's so well split between US, Europe, and now increasingly also in Asia, that we have a good offsetting items there. And this consumer demand, what we have recently seen, varies still a bit region by region in our categories. So what I said already, that current quarter seems to be very pumpy in this respect. There are several reasons still to believe that in US, in our categories, garden and the likes, we see some growth. Okay, there has been quite cold start for the season, and therefore some delays there when it comes to point of sales data. But we believe it's gradually coming. In China, even though the lockdowns there, we see that underlying demand does exist, and that would help us in future. Where we have had seen most challenges is our home markets here in Nordics. In Sweden, we have some challenges there, mainly due to the fact that our big customers, they build their inventories late Q4, and now the full Q1, early Q2, they have tried to get inventories at the right level. They are getting there. That's what we can see, but that's why our selling has been quite challenging there. And in Finland, there we have seen that consumer sentiment being a bit gloomier than elsewhere. And of course, Iittala being the biggest brand in Finland for us has suffered somewhat on that one. But overall, this, I would say, multi-category, multi-regional portfolio what we have helps us a bit in this situation.
Right. Thank you. That's assuring to hear. And one of your key strengths that we have seen has been your gross margin, as you touched upon. And we have not least seen proof of evidence in terms of when we have seen a surging cost inflation. And you have actually been able to protect this quite well. So could you perhaps break down the like key driver or components behind this? And also, are you taking any specific actions to protect the gross margin also going forward?
Yeah, we started late Q3, early Q4 last year when we saw the existing inflation there. So we started with price increases, especially in Vita business. And now Terra has followed and Crea has also followed that one. So I would say that has been this kind of short-term medicine what we have had against inflation, the price increases. But of course, we need to understand that price increases also include the volume risk, and you need to have a better proposal to the consumer, to the customers, combined with the price increases. So price increases is the first, but of course, it won't take us through the whole inflation if this continues. Then the basic things, as I mentioned, regarding consumer or commercial excellence, there are the ones. So our commercial excellence level has not been there where it should be, and therefore easy things, just starting from in-store excellence, how we look and feel in the stores, how we are now increasing traffic in our own e-commerce, our own retail stores. These are these kind of simple things we have put in place, and they are now yielding back. Then also our continuous improvement program in our own manufacturing. Own manufacturing is it's roughly 50-50 between sourcing and own manufacturing. So those actions we have put in place in own manufacturing, simplifying the production lines and the likes, they are also now yielding back when it comes to inflation mitigation.
I think we have time for one more last question before we have to finish up here. So you presented, as you mentioned, your new long-term financial targets in November 2021, and also your updated strategy. So how would you say that your execution is going on this so far, more from what you have mentioned in the presentation? And as you mentioned, we, for instance, saw that you divested your North American watering business, which, from what I understand, had below group profitability.
I would say on 80-20 basis, we are there where we plan to be at this stage when it comes to execution of our strategy. US watering is a good example. It was a mass market with very low gross margin, and we are not the ones who can be excellent in that kind of business. So we are in high premium brands, and therefore the model is built for that one. So that's a good example of divesting portfolio when it doesn't fit to our strategy. But as said, overall, I would say that all 4 transformational levers are where they should be. Okay, we have some seasonal topics there like COVID in China and the likes, but on longer term, we believe that we are on track. Then on profitability or financial targets, what we have set as a part of the strategy, there we continue improving profitability. Top line is there. We know that cash flow is getting there, and balance sheet is already at very much targeted level, or even much stronger than expected or planned in our financial targets. So its focus is now to continue improving profitability sustainably.
Great, thank you. Looking forward to keep following you and your journey ahead. So with that being said, we have to unfortunately round up here. So thank you very much, Jussi and Essi, for presenting and answering our questions. And thank you everyone who listened in.
Many thanks. Thank you.
Thank you. Hi everyone and welcome back to ABG's Investor Days. My name is Anna Danfors and I am an equity research analyst here in ABG's retail team. With me today I have the pleasure of introducing Kevin Kviblad, who is the CEO of Urbit, and you will start by taking through us a presentation of Urbit and your journey, and then we will finish off with a brief Q&A. So let's go ahead with your presentation, Kevin.
Thank you, Anna. Thank you for having me here. So, before I start talking about Urbit, just wanted to give you some headline information regarding who am I. Kevin Kviblad, CEO at Urbit since 2018. My background is from software development, and I have had the opportunity to work at eBay and Inga to develop e-commerce. Back in 2017, I joined Urbit as a chief product officer, and 2018 as CEO. So, let's start with our mission. Our mission is to deliver urban logistics service that creates a positive impact on society and environment. That is our true north. Looking at and highlight what Urbit is doing is that we are today operating in France, UK, and Spain. We are the first and only logistic company that is B Corp certified, meaning that we are meeting the highest standard both in terms of social responsibility but also environment. We have, during the years, been successful in attracting blue chip investors and clients such as Amazon, AliExpress, and also DHL and La Poste. And looking at our performance for the past years, it has been that we managed to do 34 million Swedish SEK in terms of net sales last year, a growth from 12 million, and then we managed to do almost 1.2 million deliveries last year, which is almost 600% in growth. And we managed to do all that without using any electric vans or vehicles. We are performing deliveries by e-cargo bikes, which I will come to back later regarding why is that important. Just to give you some kind of highlights regarding the moving trends across the markets, there has never been a higher demand in terms of customer-centric and sustainable logistics out there. We are seeing urbanization, we are seeing growth in e-commerce fueled by pandemic, but also we are seeing the backside. Traditional logistics is not able to cope with the volume. On top of this, we are seeing urban access regulations across Europe in larger cities where they are implementing low emission zones, which means that they are trying to put an end in terms of fossil-driven vehicles in the cities and transforming cities for people, for pedestrians, for bikes, which is in our favor. So, where does Urbit fit into this? Looking at this image, we have tried to divide it by parcel logistic, which is e-commerce parcels, and on-demand logistic, which is majority food, and then we have low-cost traditional logistics, and on the other side, we have sustainable customer-centric solutions. As you can see, we have the food players such as Gorilla Just Eat on the bottom left, but where Urbit is playing becomes unique is on top right, where we are focusing parcel logistics for e-commerce, but with customer-centric and sustainable part in focus. And given that we are internationally placed and nationally placed, which makes us unique in that sense. In terms of barriers, technical barriers, commercial technical barriers for other players to enter the market, for the local players, it's extremely tough to attract large retailers because of their limited geographic coverage. But also not having the right technical platform makes it harder for the smaller logistics company to be able to integrate and onboard large clients. On the other side, we have the traditional logistic companies that are struggling with the technical readiness to be able to meet the customers' needs in terms of flexibility and choice, but also in terms of becoming truly sustainable. And this is where Urbit plays a crucial role. We are the first and only B-certified logistic company in these markets. We have our national and international geographic coverage. We have the technical ability to be able to onboard retailers fast and efficient. And absolutely, we have now the blue chip clients and investors, which makes it more attractive to validate that our model is actually working. Looking at our strategy to become market-leading urban logistic partner for brands by creating an excellent customer experience and committing to higher standard in terms of social and environmental impact. That is important. So breaking this down in terms of where, who, and how, we actually have two hows in terms of customer experience, but also in terms of environmental and social impact. Looking at where we will operate is the largest cities in Europe, where they are struggling with impact in terms of congestion and pollution. So electric vans are not solving the problem in terms of congestion. So that's where we are focusing. And with the market regulation putting in place in terms of low emission zones, that also enables us to be able to grow. So urban logistic, focusing on larger cities in the larger markets. We focus on high growth e-commerce players that are looking to enable sustainable deliveries with good customer experience or market leading customer experience. We're looking at partners that have smaller parcels below 2 kilo, which is the majority of e-commerce parcels. So you can see it out there. We provide standard next day delivery and returns. And this is what they are looking for. Customer-centric deliveries in terms of marketing leading experience. It's kind of fluffy, so I'm going to try to break it down into what do we mean with that. In terms of hygiene expectations, is reliability, being on time, being successful, and having a customer care that can handle those issues that comes up. This is the hygiene, but still companies out there are struggling with this. This is what we offer today. On top of that, we have the truly sustainable in terms of 100% e-cargo bike deliveries with fair wages. This is also something that they are looking for. A lot of companies are not performing according to this. On top of that, we add two other elements, predictability and choice. This is for end consumers to be able to real-time tracking to see their deliveries, to be able to have seamless communication to the courier, to be able to choose their slot or change the delivery time, basically to be able to adapt the delivery experience according to their needs. And absolutely, business as force for good. Again, we are the first and only logistic company that is certified B Corp. That means that we are more than just green. It's all about how do we impact the society, the environment that we are operating in. If we want to break this down in terms of efficiency, which is extremely important, drop density is key for a logistic company and for us to be able to reach profitability. That's why we have approached a larger players to be able to have high volume with high density. On top of this, absolutely process optimization in terms of routing, in terms of removing friction along the way, making sure to be able to deliver as many deliveries per hour during your route. But it's also important to have in mind our means of transportation. Cargo bikes are 60% faster than regular vans. That means they can do more stops per hour. That also makes that we can do more deliveries per hour, which will build our profitability. But also have in mind that cargo bikes are much cheaper in terms of maintenance and purchase than regular van. So the graph on the right is just illustrating how the gross margin will evolve with number of deliveries per hour, which is important to remember. So again, density is crucial. So to just illustrate it, how this affects in terms of volume, just a snapshot from an area in Paris, from one of our hubs. As you can see on the image to the left, from January, we're handling 64 parcels for a distance of 22 kilometers, an estimated delivery time of 7.5 hours. That will end up around 8 deliveries per hour. Looking at March, when we have onboarded the client, we have a higher density, you can see that number of parcels per route hasn't increased. But look at the shorter distance that we're traveling, but also the time we're spending out there, which means higher number of deliveries per hour. This proves that with density, we can definitely start reaching profitability. So what is next? So our internal goal is to be able to reach 1 billion Swedish crown in net sales by 2025. That means that we will expand to another 2 countries, such as Germany and Italy, in total operating in 5 countries. If we break that down even more, that means 20 cities, around 5 in 5 markets, so around 4 cities per market, which is important to remember. This is where the problem is the biggest, the volume is the highest. If we break it down to just to understand what does it mean in terms of deliveries, we are discussing about 6,000 deliveries per day per city, in a market where it's 18 million deliveries per day. And in terms of how many couriers we need to employ to be able to handle this, so a cargo base can manage up to 100 parcels per route. That means 60 couriers per city per day to be able to handle this. So just a simple breakdown regarding how do we get to 1 billion Swedish crown in net sales by 2025. 5 countries, 20 cities, 6,000 deliveries per day per city, and around 60 courier per city per day. So finally, what have we achieved? We have tenfolded our volume in just 12 months. We have successfully expanded within UK and France, but also added Spain within the last 12 months. We have signed major clients such as AliExpress and Amazon, which has been extremely time-consuming but extremely important to be able to build the foundation with volume and density. And we have managed to become B Corp certified as a first and only logistics company out there. So what do we attempt to do going forward? Continue growing our volume and our business with current global clients, both nationally and internationally. Expand to 2 new countries, Germany and Italy, making sure that we reach our internal goal in terms of 1 billion SEK by 2025. That was all from me.
All right. Thank you very much, Kevin, for a good presentation. Always exciting to hear. So let's start off with some basic questions. I mean, you tend to divide your customers between retailers and carriers. So I'm just wondering a little bit where retailers usually offer higher margins, if I'm not wrong. And how would you say that you are, how is this division look now? And how do you plan on scaling on this going forward?
So it's important to remember, even though we have higher income per delivery from a retailer, traditional retailer, but the density is low. So imagine if you get 1,000 parcels per day in total in Stockholm, that will put pressure on your operation and also in terms of cost. But you have 1,000 parcels in Östermalm, that makes it much easier in terms of efficiency. So that's why we target the larger players to get the volume and density and to be able to expand. And on top of that, we will add retailers with high income but lower parcel, which makes that mix together more profitable for us.
Sounds fair enough. And as you touched upon here, you are expanding a lot, and you today also expanded one of your partnerships, I saw. But you are also expanding to a new country now, Spain, and more specifically Madrid and Barcelona. So could you perhaps tell us a little bit more about that plan, and what does the time plan look, and what kind of potential do you think that Spain has as a market?
So Spain is one of the fastest growing e-commerce markets out there. And just looking at Spain as a market, Barcelona and Madrid are extremely dense, and you have the urban regulation that is happening there, which also makes it even harder for traditional logistics company to be able to perform. So we chose that to be able to do an impact in terms of congestion and environment, but also because of the density and the volume there makes it attractive for us. And again, we are expanding with existing clients, which means that players such as AliExpress are looking for similar solution or one solution that can help them in all the larger cities out there. So Spain, we are having high hopes, and we are hoping to be able to start operating fully with volume in Q4.
Exciting. And you mentioned that you are expanding existing partnerships. Do you plan on maybe entering some new ones as well, or do you have any thoughts about that?
Definitely. We have seen tremendous positive traction regarding new clients. Again, I think the the hurdle we had to pass was the first large clients, which we did successfully in terms of Amazon, AliExpress. We have shown that we can do that. We have shown that we can manage to go through the processes of onboarding and integration. And we have proven ourselves during the Q4, which was the peak season, which we actually delivered by excellence for those clients. So those things have together built a foundation for us. It makes it easier to discuss with new retailers. Say, look at what we have performed. We are a partner that you can truly trust on.
That's reassuring. So fingers crossed for that. So, and also, as you mentioned, the number of deliveries, but also foremost drop density is key for your business model. And looking at peers in Sweden here, we can find, for instance, like Budbee and Army, which many people, I guess, think of when they hear you talk. So could you perhaps elaborate, what are the biggest differences between you and them, and also maybe even more importantly, the markets that you operate in, I guess?
I think in general, there are very similarities in terms of focusing on the customer experience, the delivery experience in health, and also trying to make sure to become as sustainable as possible. The biggest difference is that we have already taken the investment in terms of being in Europe, in the largest market. We have also managed to sign big clients, which enables us expanding to others, which is difficult if you have only clients, local clients. And when you enter a new market, you have to start over again. So that's the difference. But eventually, at the end of the day, given that we are performing by the only e-cargo bags in major city with high density, that will be the difference between us. But in general, yes, we are doing last mile. We are focusing on customer experience, and we do it sustainably.
Fair enough. And also touching upon you being a certified B Corporation, which is very rare. What would you say? I mean, we are seeing increased efforts both from regulation perspective, but also from many corporations. And for instance, PostNord was announcing that they have a more ambitious emission-free agenda going forward as well. So if you could perhaps explain for people that are not very aware about B Corp certified B Corporation, what that is, and how would you say that provides you with a benefit?
Definitely, the retailers out there are mistrusting the discussion regarding being green. Is it actually green? Are you doing carbon offset? How do you do that? And to be able to find an independent organization that you go through the process in all aspects in terms of your delivery performance, how do you employ your fair wages, etc. That makes them assurance regarding this is a partner that I can trust. Because every time a newspaper picks up that something went wrong with the delivery in terms of they are not that green, they are not paying fair wages, that will hit the brand in terms of customer churn, and then they have to invest. So this is important for retailers to be able to have that trust. So B Corp provides that for us. And again, there has been too much discussions regarding green, 100% fossil free, etc. At the end of the day, the challenges in larger cities is congestion. If you put an electric van on the street, they will get stuck in traffic. They will double park, which means that other cars behind them are there in terms of congestion and pollution. So it's not solving the problem in the larger cities. It's just pushing it to some other area. But with e-cargo bikes, we are not on road. We are actually using the cycling network, which makes it we are not putting any congestion, no pollution, but not air noise pollution either. It's also one of the problems in the larger cities.
And also touching upon that again, you talk now about two new countries that you are potentially looking to expand. What would you say do you have any specific cities there that you find, I guess in Italy, there are many like high population density?
So we look at the high population density, again, density is important, but also looking at the ongoing regulation that we are putting in place to be able to attack this, but obviously the clients, depending on the clients that want to address a problem. So clients needs, population density, and ongoing regulations as it's being implemented across those cities.
And I can imagine the regulations are only increasing, if I'm not wrong.
Definitely, it's increasing, but the time of that is also important, because in France, the ambition is to be able to have those in, I don't remember the number of cities, but a lot of cities by 2024, Why 2024? They really want to make an impact before the Olympics. And I think in Spain, they have 2025, etc. Those timelines make it extremely hard for traditional logistics to be able to adapt that to that change that fast. So that makes it, for us, as a first mover advantage to grab those opportunities right now, here and now, but also given our client base makes it easier for us to go there.
That's good to hear. And also, I mean, the last mile delivery market is, as we know, it's very competitive, and there are many new players entering quite often, I have to say. But what would you say, like, how do you view the competitive landscape when you are expanding and growing? And I mean, you do have some very important blue chip clients that you mentioned, for instance.
At the end of the day, logistics is not the blue ocean. It's a red ocean with a lot of players, but the good thing is that that ocean is expanding on a daily basis. We are seeing extreme amount of volume increase, extreme amount of parcels being returned, and with the pandemic, we have seen a jump, and that means that the late adopters have also adopted to this, and they will probably stay there because they have felt the convenience of e-commerce. So the volume is increasing on a daily basis, which means there is room for all those players to play, and they are offering different kind of solutions. You have the lockers, you have the cargo bikes, you have different kind of models. So that means that, again, if you look at the payment business, you have card payment, you have a Swish, you have a PayPal, etc. So there is kind of a market for everyone to play, and that goes for logistics also.
Can imagine. I think we have time for one last question before we have to finish up, unfortunately. But I think one thing that many people are thinking about now when we're talking about e-commerce and so on is that we have a weak consumer confidence, and we read articles almost on a daily basis about e-commerce is declining and so on. Are you experiencing this in any way, and how, if that's the case?
I think the market has been extremely shaky with the geopolitical situation that we are having. So definitely there is a kind of hesitant from end consumer to purchase because of the inflation. So the number of volume is decreasing, but also in terms of to be able to provide volume for AliExpress, they are providing from China, which means they have to fly over to Russia, which is not a no-fly zone, so it makes it difficult. But definitely there is an impact across the board, but we are working with extremely large clients. We can still get percentage increase by just expanding to new areas and getting the volume. So right now, given our size, we are fortunate to not be impacted by that, but absolutely there is a kind of a coldness on the market regarding consumer products, definitely.
That's fair enough, but still seems reassuring that you're growing, and it is a fragmented market, as you were saying, at least. So, but I think we have to finish up here, and would like to thank you, Kevin, very, very much for having you here, and for your presentation. It's going to be exciting to keep following you here. And with that being said, I think we will round up. So thank you, everyone, for listening in, and thank you, Kevin.
Thank you.
Hi and welcome to another presentation here at ABG Investor Days. My name is Simon Granat and I work as an equity analyst at ABG and I cover IT and tech companies, and one of the companies that I cover is Pricer. And with us today we have the CEO Magnus Larsson, who will present the company for about 20 minutes and then we will follow up with a Q&A session. So with that said, Magnus, please go ahead and present.
All right, thanks a lot. Hello everybody, my name is Magnus. I'm the acting CEO of Pricer since February. And today I plan to present Pricer, what we do, what makes us an interesting company, and hopefully excite you to spend more time with us into the future. So I would like to start with speaking a little bit about Pricer and what we do and why we do it. And not knowing how much you know about us, and if you have had any time to read up before, I will speak about the solutions and the products for a start. What if you imagine the future of retail? So Pricer, we're in retail space. We've been working with retail since early 90s, since 91. But then looking forward, not backwards. So how do you imagine the future of retail? When I think about future retail, I see in front of myself the reinvigorated physical store where customers go to experience something, where they go to have a fantastic shopping experience, where shopping is easy, where it's fun-filled. They know they might have a list of things they want to buy. They find it. They can get directions if they need from their app. They get recommendations. They know the price is right. They have an easy experience doing the payments. But they also get inspired, they get excited, they see a lot of things that makes them want to learn more, get to know things, test new things. So basically at the time they leave the store, they know they want to come back. And they also feel that from a retailer point of view that their brand mission has been fulfilled. So this is sort of the ambition. When I look at the future of retail, this is what I see. So a lot of things will happen and basically the physical store will really offer the best environment for this fantastic customer experience. And with this in mind, I've sort of now created this slide. So what we do is that we deliver the smart retail in-store solution for retailer. So what does that mean? They mean that we build solutions that enable a shopper to get a fantastic experience in the store. They should be able to basically find what they need. They should get the price they need. If they're looking for something, it should be on the shelf. If the product, for whatever reason, is not on the shelf, there might be a recommendation saying, well, you were looking for this product, but we would recommend that you have this product. Our solutions also enable the retailers, the store owner, the chains, to run their store in an efficient way. We help them by a lot of different kind of use cases. It could be cases for doing replenishment. So their staff needs to stock up. And then with the help of our flashing of the labels, we can direct them and say that this is what you should do. When they do the click and collect, they have a web order. We will make sure that they can do it in a faster way. When they have new staff that is not aware of the store, or the layout, or how things are working, we can help them with the directions. And the store can actually lead them in the process to make it faster and better. We also want to make sure that we help the retailers maintain the customers in the store. And one of the reasons why customers are leaving is that they don't find the product they're looking for. They go to a store with a very specific target in mind. Let's say they want to buy a hammer, and for whatever reason they cannot find this hammer because it's not in stock, it's out of shelf. Very often, instead of staying and shopping the hammer and getting a few more products, they will leave. And at worst, they will actually go to another store and just realize that they like this other store better. So for a retailer to attract and keep the customer is key. And the best way of doing that is make sure that they always have the product on the shelf that they want. So this is where we have solutions also to make sure that we help them know what they have on the stock or on the shelf. And we know that we can actually help them with an action to replenish or reorder or market something else, an alternative product. But we also give solutions that will create appealing promotions, that they can actually not only then create the customer satisfaction or get the cost down through efficiencies, but also that we make sure that they they increase the sales by having good, appealing promotions. We inspire customers and excite them, and they just realize that I really have to buy this fish and do it this way that I could see on the promotion. So we try to basically cover all these areas. We want to make sure that the retailers get happy customers, that we are part of this journey, that we get the cost down, and that we get sales up. But how do we do it? So, well, there is an underlying technology, of course. And historically, we've been focusing on selling electronic shelf labels, or ESLs. Those are the digital price tags that you will find in a store. And what separates us from the rest? Well, our technology is the most reliable, the fastest in response time, and it's extremely energy efficient. And of course, this is something that I guess that everyone will actually claim. But we do have a unique selling point compared to the rest, actually. We have made a technological choice once upon a time. So we communicate through IR, whereas most of the guys are using radio. And this might sound like a pretty basic thing, but it gives us the ability to be extremely efficient when it comes to energy. So when the retailer, when they want to update the price several times a day, when they want to use the flash to direct the staff, when they want to change the display to look at the stock or information about next delivery, all this stuff they want to do, we know that we can do it for much longer than anyone else. And this is one of the key requirements when you sell the service to a retailer. They want to make sure that the information they have on the screen is correct, and they want to make sure they do not have to change the battery or change the display, and they want to keep this for a very long time. And here we have a unique position. We have also developed a shelf camera and a product called Shelf Vision that we mount on retail shelves. So we can basically then monitor the availability of products on the shelf. And if we realize that there is a gap, then we'll send an alarm to the retailer saying that we have notified that you have a gap, or we have seen that you have a gap on this specific product. And we'll let them take an action. So we said that we will not take the action, but we'll make sure that with extreme accuracy. And here, actually, we base whatever we do on our own patented technology. And with this technology, there is no one that can actually come to the accuracy that we can. So then we'll give them a guidance and say that, you have to do something about this product. And through a number of pilots that we've done now, we've seen that we managed to reach accuracy levels that the retailer said, well, this is fantastic. And this is actually something that will, make it worthwhile for us to make an investment in this technology, because you are helping us to keep our customers in the store. All this is tied together with a SaaS component. Historically, we've been very much a hardware company. We have developed since a couple of years ago more software components and a SaaS solution. We call it Price Plaza. And it's orchestration and management of not only our own products like the ESLs and the infrastructure, but also functionality features. The store app that we have is a software for retailers to actually do the basic operations in the store, but also to manage the shelf vision, but also third-party solutions. So I see that over time there will be more and more third-party solutions also in the Pricer Plaza space that we call Pricer Mall. So this as large is actually what we do and how we help retailers. Looking at who these retailers are, here is one of those brag slides, but I'm really proud to present it. So we have Carrefour, where we have an exclusive contract. It's one of the leader retailers in the world. They choose to sign an exclusive agreement for our technology for all their own operations, but also for all their independent stores, for the franchises and companies associated with Carrefour. They all have the right and are recommended by Carrefour to use our technology. And this was done after a pretty long period where they were testing the use cases, they were testing the reliability of the system. They were spending a whole lot of time understanding how they can actually maximize the profit working with ourselves and our solutions. And then we were selected. So we have business with Carrefour in quite a few countries across the world. We have Leroy Merlin, who is a really large do-it-yourself company, one of the leading ones in France, where we use our technology for their do-it-yourself in France. We have Canadian Tire. That's a pretty recent win. We won it in 2020, and we are now deploying at full scale. This is what you can call a general retailer. They have pretty much anything you can imagine in their stores. The biggest stores have up to almost 150,000 separate units or SKUs in the stores. It's a massive operation. And here we have an exclusive agreement for them for Canada. Norgesgruppen, retailer within food. It's one of the biggest in Norway. We work with pretty much all their formats and brands. Best Buy, it was our first major win in the US market or North American market. We have deployed more than almost 1,100 stores or in both US and Canada. So I think that's actually all the Best Buy stores that there is. And I can see the effect now. I was just coming back this morning from a trip to the US, where our sales team told us that they basically get calls on a daily basis now from people that have seen us, especially in Best Buy stores. But we can see the same thing also in the Canadian market now. So having this installed base where it's a nice install, where it's everywhere, and with such a well-known brand as Best Buy, has been a fantastic promotion for us. And for the Swedes on the call, we have a lot of stores together with ICA from most of their different formats, both the Maxi and supermarket and so on. So that's pretty much some examples of our customers. So what are the trends in the market? I mentioned inflation as point number one. Inflation is not really a trend. That's more an event maybe that's actually triggering investment decisions. We can see it's driving the ESL take-up, and it's going back to one of the founding ideas of the company. When Pricer was founded in 91, we had this massive inflation in Sweden, and they just realized it would be easy, instead of printing massive amount of paper to change the pricing, if they can do it electronically. And we can see that now. Store owners, we have examples from Sweden where last year or the year before, typically from getting the interest in buying to actually buying was 1 to 1.5 years. Now it's down to 2 to 3 months from first contact until they actually have a deployment. So here we can see it's clear trigger. We see that also in other European countries. We see the same thing in the US. Another thing that we've seen a lot of in the US especially is how limited staff availability is affecting the need for ESLs. If there is no staff available, and in the US this is a fact, it's really hard to get people. And wherever you go, you can see staff wanted sign. You can see that there are not enough tills or point of sales open because there's no people. So if they can get a system like ours to actually help directing the staff, making sure they can work with less people, it will help them. It will help them to stay open. It will help them to have the staff they have working with, helping the customers and making sure that the basic functionality of the store is running. We can also see that many retailers are now seriously investing in digital transformation, where they look at the back office, they look at the PDAs, they look at all their in-store processes. And here, of course, we have a core place in that strategy, because then we will actually make it materialize in the store. It will be easy for the customers to see and for the directions of the staff. But we've seen it gradually increasing over the last couple of years, but now it's more than a trend, it's a fact. We can see they are also getting ready. So they spent some years investing in the basics, and now it's in place. So now they're ready for the next step, where we would actually come in play. The shelf vision pilots, I mentioned it briefly before. We are running a number of pilots. They are successful. We have achieved availability, or where we can actually analyze gaps and say that you have a definite gap in your shelf with more than 95% accuracy. And at that point of time, it's a definite go, because then you can see that this investment will make a whole lot of sense for the retailer, because they will be able to get products on the shelf and then keep the customers in the store. And final thing that we see is the digital solutions. And when I speak about digital solutions, it's also about signage solutions. So we can see now with the 4 colors displays that are coming, and I will touch upon that a little bit later. The bridge between our electronic shelf labels, which are based on e-ink paper, and displays that could typically be LED or LCD or a number of TVs connected together, is growing smaller. We can see an interest from customers, both existing and new customers, to actually say that Pricer, if you do the ESLs, we also would like you to do the communications on our store TV or on a LED display, where we can see some videos as well doing promotions, sort of ending up in the more of a sales pitch. So those are the key trends or events that we see right now. Looking at who we are, I saved this one a little bit later. It was initially first, but I think it's better here. So what we've done so far, we've sold basically 250 million ESLs. We manufacture right now around 25 million ESLs a year. 200 employees or 220 employees. We have sold our systems to 19,000 stores in more than 17 countries. We have offices in 10 different locations in Europe, in Asia, and in Americas. And on the financial side, now looking at the last 5 years that are all public, we have had a CAGR of 21%. We are actually the only company that has been profitable for 5 years. I think until today, we've pretty much only been the only company that has been profitable, even though we can see that some people are getting in that direction. And of course, without saying too much, I expect further growth for the company. Then the Q2, or the first quarter this year. Here we actually had a record order intake. It was the second highest order intake ever. And from a net sales point of view, it was the highest Q1 we've actually ever had. The flip side of the coin was, of course, that we had to issue a profit warning when we were affected by the increased cost sides in the aftermath of the pandemic. But what I really like to highlight is the fact that we are growing, and that we are growing quite a bit. So that's what I would like you to stay with and keep that in mind. This is my final slide. So summarizing, there is a clear need for in-store digitalization, pretty much any form, and we can see that it's growing. We can see that the market is growing very fast. We can see that, and that might also be like a trigger. We see that certain markets are just waiting for that ignition. In Netherlands, we can see it happened when 2019, Ahold decided to actually go for ESLs. Then 2020 followed by Plus, then 2021 followed by Jumbo, and pretty much going from zero to a massive deployment with all the top 3 retailers happened in just 3 years. And that's something I expect to see in quite a few markets now. Inflation, lack of staff, I mentioned it, it's event triggering investments. We will see that will happen both in Europe and in the US market. I would imagine that will also happen on the APAC market. Then launching 4-color ESL. It sounds like a pretty trivial thing. So up until today, we've been able to do 3 colors in an ESL. And in our case, we've sold black, white, and red. It has been possible to do black, white, and yellow as well. But with 4-color, we all of a sudden have the possibility to address especially the retail market, the grocery retail market in US, in Canada, in Australia, in the UK, New Zealand, where there has been, and probably many other countries, actually many other countries as well, but there has been a habit of actually combining red and yellow when you do promotion. Red for a good price, yellow for the promotion. And the fact that we haven't been able to get that on ESL has been enough reason for some of the grocery retailers to say, we're going to wait until we actually have the 4-color. And now come to the really nice thing, because the 4-color requires a lot of power, something like 30% more power than the traditional ESL, which means that with our ability to do very energy efficient communication, we are basically in best position of all competitors to actually deliver this to a retailer that want to have, it should be a standard ESL, we want it to live long, and we want to use it frequently. Well, you should come to us, because we will be the only guys that can deliver it properly within the coming couple of years. But having all these things happening on the market, we want to capture it, of course, and we want to make sure we grow faster than the market. And I would be happy to take more deals from our competitors. So to achieve this, we have now developed we have done an updated strategy. And this is something that we will present now on the Capital Market Day that we will have in Stockholm on June 8th. So I hope that you have the possibility to come. And if you cannot come in person, there will also be an online session, of course, recorded material afterwards. So that's pretty much what I had to say about Pricer.
Thank you so much for that introduction and the presentation, Magnus. It's very nice to hear your thoughts, given that you are fairly new in the CEO role.
Thank you.
Initially, could you talk a little bit on why a reputable customer such as Carrefour or Best Buy, why do they choose you? Is it a combination of all the things you are talking about? Is it about price? What makes them choose you as a supplier?
I think that the key reason has been the reliability of the system. So what both companies have done, and also Canadian Tire, is that they have had pretty thorough procurement processes where, of course, we've been discussing price and functionality, but above all, they've been testing and testing and testing and testing, because they want to make sure that the ESLs works in the retail environment. And if they want to do a high number of display updates, if they want to do a lot of flashing, if they want to make sure that the battery lasts long, and they want to make sure that the response time is good. So we offer a better response time than competition as well. I mean, that's what they wanted to test. And when they've done the test, they realized we came out the winner. And so I think that's the reason.
That's very interesting. And some of the companies you mentioned are obviously very, very big customers, but you also have a smaller companies in your broad base. What would you say is the optimal customer for you? Is it to go for these larger companies, or is it for the smaller ones, or is it a combination? How does that matter for you?
I think it's a combination. I think it's about the go-to-market model. So we work with direct sales, but we also work with partner sales. And here we have a wide range of partners. We have large partners that has the ability to deal with really large retail customers in their country or in countries. And then they will drive much of the business, and they will, of course, add a lot of value in the work they do. Then we have smaller ones where they address small stores, or it could be special type stores. You could say that we have a retailer or a partner that would just do pharmacies in the country. So it's really a mix. And I think that we are in good position to both take the major contracts with the biggest retailers, but also I'm happy to see that we can serve the smaller ones.
And I know that in recent year, the North American market has gained really good traction, particularly for you as a company. What would you say has happened in the North American market that has driven this increased penetration of ESL solutions?
I think that what we see is a number of things. One is actually the lack of labor. But there has been a few retailers that were quite fast working with or quite early working with the efficiency in how to work in the store. If you take Best Buy, under Hubert Joly, who was the CEO at the time they made the decision, he was struggling to turn Best Buy around from a company that had a pretty tough time. And his idea was that he wanted to have his staff focus on the customers and add an exceptional customer value to their shoppers. And then he wanted to make sure that, of course, they should have to spend less time with all the administration around it, but also about the presentation, that it was a nice design or nice display, very clear information. So that was one key driver. And then we can see that it's been very much non-grocery, a lot of specialty stores. We actually have the world's biggest furniture store in Nebraska Furniture Market in Dallas. I just visited them a few days ago. It's massive. And here our ability to really deploy at scale was one of the key things, where they say that it's a difficult environment. It's hard to make it work. But we do, and we definitely add a value. It's to the extent where actually, it's really funny that when the store staff realize that we are there, the partner there, some of them come to hug us and say, well, I'm so happy you made it work. And this sounds very cheesy, I know.
It's very nice to hear.
Yeah.
And I know for the past few years, you have had Pricer Plaza out in the market. How has the sales conversation changed over these 3 years when you have had, or approximately 3 years when you have had the product in the market? Is it starting to loosen up in terms of the sales process, etc., or how do you sell this solution?
It absolutely is. In the beginning, it was much about proving that we actually know how to build a SaaS solution, that we have a credibility, that we understand the complexity, that we can assure the security. So as part of also this, to really show how serious we are, we did the certification for ISO 27001, which is the security certification. So that we've done, and now we've come to a point where we can say that SaaS is pretty much the preferred choice for most of the retailers that we discuss with.
And are you looking to enhance the software through even more partner integrations, etc.? I know you touched upon the subject during the presentation as well.
Absolutely. I think it's really important that we have an easy to engage with platform with good ways of integrating and being a part of what we do. And this is a journey we're starting right now. But also we're filling up with our own functions and functionalities and new features through Plaza. So, but I do expect to work with more partners as Plaza partners into the future.
It's very interesting. I know that it's a question that I've asked previous CEOs, and I'm just going to ask you as well. Is M&A going to be a topic for you in mind when talking about the software solutions, etc., or would you say that it's rather an organic focus primarily, and then adding these types of software?
So we're looking at right now at organic growth, but we are opportunistic, and if we have the right opportunity, I'm sure we will see what it could bring.
Very interesting to hear. I think our time is up. So thank you so much for attending here today, Magnus. It was a real pleasure having you here.
Thank you very much. It was a pleasure being here. Thanks a lot.
Thank you.
Bye.
Hi, and welcome to our next company presentation, now with Netel. And with me in the studio, I have CEO Ove Bergqvist to present the company. Myself, my name is Max Bacco, and I am an equity research analyst here at ABG. And with that said, Ove, please go ahead with the presentation.
Thank you, Mats. Netel works with infrastructure. We do maintenance, we do service, and we build infrastructure. We do telecom, fixed networks, we do mobile networks, we do power grids, we do water and sewage, we do central heating, and related civil engineering work. We have a long history of growth. We were started as a management buyout from Peab in 2010. The company itself was started as a small unit within Peab in the year 2000. So from 2010, we have an annual growth rate of 24%. All of it has been profitable. So the average growth rate of profit is 20% in the same period. We have an asset-light model, which means that we buy lots of services from subcontractors. We buy excavation locally, we buy installation where we can. So we have a high cash conversion. We had it historically, and we still have it. We have a clear view on how we will sustain growth. We had 45% growth in Q1, of which 16% was organic. We did 4 acquisitions, or we have done 4 acquisitions year to date. We are in infrastructure, and we've been in infrastructure in, 22 years now. As I said, we started within Peab, and then we did a management buyout. And we group infrastructure in 3 groups. One we call fixed, and that's the biggest one for us. That's fixed telecom, mostly fiber and cable TV in our case. We also put in what we call infrastructure services in here, and that's water and sewage, central heating, and related civil engineering work. We do power since 2018, and that's the power grid, the public power grid. So we do local networks, we do regional networks, we do cable, we do lines, we do stations. And then lastly, our first original segment was mobile. So we build base stations. We do the towers, we put radio in, we install radio, we do the cabling, we do the fiber, we do the power, and we switch it on. We started out in Sweden and Norway, where we are complete. We added Finland 2015, and then 2018 we added Germany. Germany is way behind in its fiber deployment. So if Sweden has 90% coverage, Germany has 20%. So we are building fiber in large volumes for Deutsche Telekom and E.ON, which is called EDIS in Germany. The next step should be UK, which we are working with now to start operations. We think, or we have strong trends in the back. Therefore, we are in good segments. There is high demand. There is good short-term demand, but there is definitely a long-term demand. There is electrification. We are in the power grid. The power grid is old. The power grid lacks capacity. We build a local network, we build regional networks, and we do station and we do lines. There's of course digitalization. We do mobile stations, which is 5G. We do fiber. We service fiber, we build fiber, especially in Germany these days, and we will do it in the UK. And then lots of these infrastructures are old. The power grid is very old. It needs to be much more reinvestments. Water and sewage networks are old, and central heating networks are very old. So the trends are strong. Q1, good growth. We had 45%, 16% organic growth. The backlog is strong. Historically, at a turnover of 2.5 billion SEK, Netel would have had a backlog of roughly 2 billion. It's 3 billion now, and the reason is that we have more service contracts, and they are quite big and they are long. And that's with Telenor, and that's with Telia, and that's with Global Connect. So the backlog is now 3.4 billion SEK, and that's the highest backlog we ever had in Q1. If we look at profitability in Q1, we had 4.5% EBITDA, We had 4.5% last year. Q1 is our smallest quarter with the lowest margin. For example, in 2020, 2 years ago, we had 2.2%. So 4.5% the first quarter, we do work outside. It was cold this year, lots of frozen ground. That's a good quarter for us. Of course, there are risks, and we will talk about them with inflation and so on. But for the first quarter, in these circumstances, a very strong quarter profit-wise. If you look at organic growth, we have organic growth now in Norway, especially in Norway and Germany. Norway is driven by the fact that we last year won big service contracts with Telia. We do all of Telia's cable TV network. And we won a few areas of Telenor's service contract. And we won them last year, so we will have year-on-year effect this year. And that will give good organic growth on top of everything else. And then Germany. There is high demand for more fiber in Germany, very low penetration. There is a lack of suppliers. So we will have good growth this year and many more years in Germany. Sweden, 85% growth, but that's mostly acquired. I will get back to the acquisitions. So all the business areas good. Power good, good demands. Mobile very good because there is a 5G rollout now in all countries, so lack of resources. And we have, from numbers, we have compensated ourselves well for cost increases. Much of what we delivered today, we bought some time ago. We have also, we put tenders and bids continuously. So when prices are going up, our bids are going up, of course, and so on. But there are uncertainties ahead, of course. And one uncertainty that we might see, which we haven't seen so far, is that for our customers, for our network owners, it's also more expensive for them to build. So they might hesitate for some time to actually start projects. We haven't seen it yet, but that's definitely a risk. We do acquisitions. We work with acquisitions all the time. We do it proactive. So we have a number of companies we talk to proactively. We have done 4 this year so far. What we do is we try to take position in our markets. We try to be stronger, or we try to enter new markets or new segments. So we're going to stick to these segments. We're going to stick to these countries, but we're going to add UK. We only buy strong companies. Almost all of them are higher margins than Netel, and Netel has high margins. We want management to stay. We want them to develop the company. We want to develop Netel. Of course, we look for cost synergies like purchasing and so on, but the biggest synergy is on the revenue side because these are good markets, good trends. So together we can make more business. That's the theme with the acquisition. We have done these 4 this year so far. JR Markteknik och Täby Maskin is a company in Stockholm. They have frame agreements with Uppsala kommun, water and sewage. They have frame agreements with Vattenfall, water and sewage. It's a very strong company, very high margins. They will have a good year this year as well. Eltech is power. They are working up to 400 kilovolts. So this is our first company who is doing 400 kilovolts. So it's a good start for us. Elcenter in Söderköping. It's chargers, it's solar panels, and it's street lighting. Karlskoga Mark is also water and sewage. It's frame agreements with the municipality and local housing companies. All of them with good margins. And this picture says that we have for what we planned this year, we have enough cash, we have a good relationship with the bank, and we have enough means to actually do the acquisition we planned for this year. And then finally, the markets, the underlying markets are very strong. This is infrastructure. These are power grids. This is fiber infrastructure. This is telecom. This is water and sewage. So yes, it can go up and down, but the long-term trend is very strong, and the trend right now is very strong as well. We have been growing with 24% the last 12 years. We have been growing profit with 20% in the same period. We had a very strong Q1, good margins, same as last year, very high growth. And we continue to do acquisition. And we have done quite a lot of acquisitions in Sweden. Now extra focus is on Norway, Germany, and the UK, which we plan to enter this year. Thank you.
Thank you very much for a nice presentation. And now over to some Q&A. And I would like to start with your Q1 here, where, as you said, you report adjusted EBITDA margins of 4.5%, which was the same as the year before, despite the cost inflation we have seen, despite the high sick leave due to Omicron in the beginning of the year. And I've seen that some of your peers, on the other hand, saw quite significant margin pressure in the quarter. So if you could perhaps explain a bit more why you, Netel, managed to maintain your profitability level year over year.
No, I think we see some of that as well. But I think the underlying pressure for more volume to actually complete your projects, do more, is actually taking some of that off. So if this were a normal year, it might have been even higher.
Yeah.
And then we do projects, and we try to, when you win a project, you try to order all your material. So the gap between is very small. For many construction projects, if the cost increase is big, you have the right to compensate yourself. Of course, you end up in a negotiation with your customer, but you can compensate some. And then there are indexes, especially in water and sewage and civil engineering. Each year there is an index adjustment. And that this year, I think, is 9% for people and 17 or something for machines. So everyone knows this. And also, not all customers, but some understands we need to compensate because otherwise nothing will be done. But then, as I said, the risk might be that, okay, this is expensive. We might wait to actually start the project.
Okay. And as you mentioned, the German market, where you see as a key market going ahead with in terms of growth. And as you also mentioned, the fiber penetration, if we look at homes passed, is around 20% or something like that. But have you seen now that the fiber rollout really have started gathering momentum? And
so, I would say. It's a lot. There's a big demand, but it's still quite inefficient, at least where we are. But then there are many network owners, and we know Deutsche Telekom and we know Edis, and they still want to do much more than they're capable of. So there's still, I think the peak is still pushing out further in time. If they said 2025 before, they might say 2027 now before sort of peak volumes.
And what is holding the German market back? Is it financing, or is it installers, or is it?
When you start a sort of infrastructure project where you're going to do lots of things in the ground and cover big areas, you need to have permits. You need to plan it. That takes a long time. And if you want to say, tomorrow we're going to build, okay, you can't actually. Because you need to go to landowners, you need to go to house owners, you need to go to the municipalities. So I think the whole planning phase is, because you want to build so much at the same time. So the challenge is quite massive to actually just start the project.
And also, you mentioned during the presentation, and I saw that this was something that you mentioned in the last report as well, that you aim to strengthen your position in Norway and Germany, but also you intend to enter the UK market. Could you elaborate a bit why you find the UK market attractive?
We went 2017, when we were on sort of peak volumes in Sweden on fiber, we did 900 million for one customer. And then we said we need to do other things as well. And then we have diversified. Then we went around in Europe. So we went to UK, we went to Italy, we went to Germany, and we stayed in Germany. But they also had good contact in the UK. And they were far behind, and they're still far behind. I mean, you can pick other countries as well. But first we did Germany and then the UK, big countries, and not necessarily good. But I think in this case, I mean, you can talk to them. We have a good name. I mean, if Netel goes to another country and explains that we did most in Sweden, would you want to talk about projects? They say yes. I mean, it's a fact. Otherwise, we would never have done Deutsche Telekom. And then we ended up now we end up in UK. And that's partly because we have good contacts. We have people we worked with before who now are in the UK who will help us. We have people in our company who wants to go to the UK, which is also important when you pick a country, because you need your own people there as well. So many factors.
And UK as a market, is it similar to Sweden or Germany in terms of profitability and growth and competitiveness and so on, or is it?
I would think so.
Yeah.
I think when you look at these companies now, they're very profitable because the market is booming, lack of suppliers, customer wants to build a lot, they want to build fast. So I mean, it's a good ground for profitability. But what we do, we enter with fiber, but then we need to follow. Then it needs to be water and sewage, maybe telecoms, maybe central heating, because fiber is a good entry point, but then the strategy is to broaden the scope as well, to become a complete Netel.
Yeah, and a common topic, at least for me, I mainly focus on the fiber area, but I guess it holds for all areas that there's a lack of qualified installers, something that is often described as a bottleneck in the fiber rollout, for example. Do you agree with this statement?
Usually not, actually. No.
Okay. Yeah.
No, usually not. I think what we see, we have a lack of skilled project managers.
Okay, yeah.
To really keep the project together, because it's quite easy. Each bit and pieces are quite easy, but there are many.
Yeah.
So a good project manager that can keep it in shape, know what to invoice, make sure the invoice is okay, and get the money in.
Okay.
I think that has been the biggest problem, always.
Yeah. Okay. And a few quick ones on acquisitions. You have done 4 so far this year. What is the average paid multiple if we look at Ebitda or something like that?
We are between 3.5 and 6, I think.
Okay.
6 is high.
Yeah.
But we have done most in Sweden.
Yeah.
So we are not. I think it's a little bit more expensive in Norway actually. But it's very dependent on how much is actually rollout and how much is service. Service is more expensive than rollout.
Yeah.
How much is installation and how much is rollout.
Yeah.
So average is maybe 5.
Okay. Yeah. And the payment structure, do you work with earnouts or is it cash up front or?
Always earnout.
Yeah.
Always reinvestment in Netel. So we say, okay, we want to buy your company. We think it's great, but you have to like us as well, and you have to be part of building this. So like 25% of what we pay you, you invest in the group. Everyone is invested in. So some of the biggest owners are actually people.
Okay. Yeah.
And then there is an earnout of 2 to 3 years.
Yeah.
With actually, if you earn more on average in 2 to 3 years than you do now, then you get the same multiple on that.
Okay.
That you make above the average.
Yeah. And you said that you mainly find companies with margins above the group.
That's one of the very important criteria. Yeah. So that's one of how we put the list together actually, because we promised 7% EBITDA, and that's high in our business. And then if you buy something at 10, at 5%, at a multiple of 5, that's good business.
Yeah.
If we can keep on delivering those numbers.
Yeah. And beside this margin criteria, what else financial metrics do you look at?
Sectors extremely important because we have to invest in sectors we think we believe, where we can see growth. So nothing outside of that. Management, they must stay, or we need to have a plan from day one, because we are very decentralized. We are 5 people on the group level.
Okay.
So we run them as we run our own units. Yeah. Very decentralized, very strong, and we try to find sort of revenue synergies in between. So profitable, right sector, management who wants to stay.
Yeah. And what is the size on the acquired companies? Is it revenues of 100 million SEK or something?
Between 30 and, what we look at now, up to 200.
Okay.
But rather more than one big has been so far.
Yeah.
It might be look a little bit different when we go to Germany.
Yeah.
It depends. But above 200 is big for us.
Yeah, okay. And finally, my last question, with your customer concentration, do you have one single big customer that is 10-15% of sales, or?
Yeah, I think Telia is like 15 maybe, but Telia Finland, Telia Norway, Telia Sweden, and then they have different parts of it.
Yeah.
So I don't think, if one Telia is getting upset, that Telias would bother actually. So historically we had one fiber customer in Sweden who had we had a big dependencies, but that's much smaller now.
Yeah.
But if you if you want to work in telecoms, there are just a few big customers.
Yeah, exactly. Yeah. Well, I think that was all the questions from me. Ove, thank you very much for the presentation and answering all of my questions, and good luck going ahead.
Thank you very much.
Thank you.
Hello everyone and welcome to ABG's Investor Days. My name is Carl Bokvist and I'm an industrial analyst here at ABG. With us today now we have Permascand and CEO Peter Lundström who will be moderating the presentation. And afterwards there will be also a short Q&A session from my side. With us we also have CFO Linda Ekman tuning in. So without further ado, Peter and Linda, thank you for joining us and welcome.
Thank you very much and welcome to Permascand. The one who will present will be me, Peter Lundström, I'm the CEO. But as said, Linda Ekman is in the background, so if there are any questions that I cannot answer, she will be for sure be able to do that. I take the opportunity today to introduce Permascand. We talk a lot about our core technology platform. I will go through that a little bit. Looking into where are we heading, what do we want to achieve, what have we done so far, and what are our financial developments. We just closed the first quarter. We had that 2 weeks ago, the presentation, but let's summarize it up. Looking into the investment highlights, what do we want to do going forward, what can we expect, and so on and so forth. And then we're ending with Q&A held by Carl. So I think we can change page. And I'll start with the vision and mission, because I think that is describing Permascand quite well. And there are more wordings that are more important than others. But for us, it is to become the leading independent provider, global supplier of electrochemical solutions, and we would like to do it for clean tech applications, and we would like to support and be part of the green technologies and the green transmission that is going on and that we're heading towards. If you look into our mission, I mean, what are we doing every day to fulfill our vision? And that is to be innovative every day, to be competitive, to make sure that we can produce, that we can present the best technical availability, and how are we supposed to produce it, and how are we supposed to produce this in a large scale. And in particular, when we're looking into the new markets, the electrification and renewable side, I mean, that is a large scale market from where we are coming from. We are serving 3 markets today. Industrial solutions, that's where it all started 50 years ago, 1971. It is basically chlorate industry, and it is chloralkali industry. So we are serving the chemical industry and the paper industry. Water treatment, for us it is primarily the ballast water treatment. The legislation came into force in 2017, and it's new installations going on for another 3-4 years to 25-26, when all the vessels that are crossing the oceans are supposed to have finalized an installation to be able to continue with transportation over the oceans. And then we have the newcomer, or it's not really something new, but it seems to be the one that takes in and will fulfill the green transition that everyone is looking for, and to also lower the emissions that is going on in the industry. And for us, electrification and renewables, it's actually 3 parts. It's hydrogen, which I know most of people know. It's metal purification. We call it electrowinning. That's how to create metals and to purify metals so we can produce cables and the batteries and so on and so forth. And it's power transmission. We need to be able to transport the electricity within the countries, across the countries, and that is also creating corrosion in this part of the value chain, and that is what we are focusing on. I can take the next page. We are established in Ljungaverk, in the middle part of Sweden. It's basically when you put a needle on Sweden, that's where you end up in Ljungaverk. So it's very close to us. That is where we are having the main part of our operation. That's where we do the research and development. That's where we have the construction, the design, and most of the manufacturing of our components is there. We have a set of partners across the globe, basically in all parts of the world where we have customers or where we think that we will be able to grow our business. And they're doing the assembly work, they're doing documentation, test and inspection, And they are producing for Permascan. We set up the standards for it, and they are delivering directly to the customers more locally than we can do from Ljungaverk. We have sales office or product offices in Stockholm, Gothenburg, and Vancouver in Canada. It's all started in 1971, so we have been part of the AkzoNobel group up to 2012 when it was a management buyout, and we went into the stock exchange market last year as a celebration of our 50 years anniversary. Let's move on to next. Just to take it in the simple form, I don't know many are listening that knows anything about the electrochemistry, but if you take it from the starting point of it, it's quite simple, and when you get into it, it gets more complicated along the line. But from the simple form, it is something called an anode, a cathode, it's a plus and a minus. You add electricity, you put this down into some type of liquid depending on what you would like to do, and normally you are making a purification or you're making, as we do for ballast water treatment and disinfection, and we're using electricity to create a reaction, and this is used in many different industries and a quite global large market for it, and we are focusing on the markets that we believe that we can be successful and that we can kind of be the heart in the customers' processes, utilizing the core technology and the experience we have from 50 years of service. You can take the next one. We do it, and this is really no secret. Everyone in the electrochemistry area, they are having basically the same building blocks, but we're focusing on the coatings, the catalytic coatings. That's the secret sauce in Permascan. That's where we have the patents, most of the patents. That's where we have the trademarks, and that's where we have the know-how. We build electrodes and we build complete electrochemical cells. And our business model is to do new installations, but it's really the aftermarket and service business that we're focusing on and that we would like to be part of with our customers for a long time, from the starting point to the end. The oldest refurbishment and aftermarket service customers we have from beginning of the 80s. The oldest electrode material I have seen is from 1982, and they have been part for the service now for 4 times since then, and that's how we are operating, and that's what we want to be, a long lifetime partner to our customers. Let's bring up the next one. What this industry is aiming for, it is at the lower part of this circle. It is to create components and products and a reaction for disinfection or for purification with as low energy consumption as possible. At the same time, it is to have a long lifetime on your electrodes and your electrochemical systems. And it's around to have a very cost-efficient total ship of owner cost for our customers with a very high reliability. And we normally use the terminology that we produce the heart in customer systems and in customer processes. It's not supposed to be us that are failing or not working in the process. It is exactly the same as the heart in the body. I mean, it's just supposed to pump, because then we know that everyone will continue to deliver, and we know that everyone will continue to move on and keep that going. And we do it through kind of a set of different processes and functions. It is the research, it is about the optimization of the coatings, it is about the product applications, it is about the methods to produce both large scale, small scales, and be able to repeat that when it's time for an aftermarket and service. And it starts with the coatings. How do you apply it? How do you make the recipes? How do you optimize it? What do you do before? What do you do after? And how are you, in the end, assembly this in a very reliable way with long guarantee, low energy consumption, and long lifetime that keeps downtime as short as possible for the customers. We can take the next one. It is a quite long process to get there. I mean, we have a sales and development process going basically hand in hand. There are many different steps to get to this commercialization and to get to this long lifetime optimized electrochemical cell that will be put into a factory or an OEM system for the customer's processes. It can take as short as basically 1 year. It can take as long as 8 years. In average, within the industry, it's between 5 and 6. It seems to be going a little bit faster when we're looking into electrification and renewables, and we're talking more from the first contact you have with a new customer that you don't really know, 2 to 3, maybe up to 5 years. It seems to be a shorter timeline from the starting point to commercialization in electrification and renewables than it has been in the past from the other sectors and industries. But it's a quite sophisticated, it's a quite hand-in-hand process to get to the end point to deliver quality products and quality components for the customers. Can take the next. Permascand, we have a clear strategy on what we want to achieve into these different sectors. And for us, the markets are as well as important as the other one. We're not really prioritizing one or the other. We're using our experience from Industrial Solutions. And if we're looking primarily where we are in Industrial Solutions now, it is to strengthen our aftermarket and service business. Focus is on North America. Focus is to be more presence, to set up a Permascand establishment more permanent, and also to be able to then be closer to the customers, to increase their performance, and to give them a very high customer support. We have started to employ new resources in the area, and we are looking into our possibilities to take the next steps into this market. If I go to the left, which is the water treatment, I mean, it is commercialized. We have invested heavily into this business, and we are one of the major players in delivering components and electrochemical cells to the OEM and to the system integrator who are installing them on the vessels across the world. We are halfway through the installation curve. It's 48,000 ships. That is the market, and we are around 25,000 at the moment, and it's supposed to be finalized somewhere between 25 and 26. So the only focus we have is to make sure we can deliver, have the capacity, and install as many systems as possible. Because when it's finalized, it's going to be, as Industrial Solutions, is primarily driven by the aftermarket and service, and that is where we're heading with that. We are investing the money that we are making and the cash flow we're making in Industrial Solutions and in water treatment into this new area of electrification and renewables. It is the hydrogen, it is the power transmission, and it is the metal purification that is our focus. And of course, hydrogen looks like to be the largest market potential for electrochemical solutions that we're focusing on. And it's very simple: winning new customers across the segments and growing aftermarket and service, and protect our market and our business through our innovation and through our technical solutions and through our abilities to manufacture large-scale components and large-scale electrochemical cells over and over and over. Let's take the next one. We have so far, we invested from 2018 into automation and robotization, because that is how we are getting the scalable manufacturing, the flexibility, and also the profitability in the company. We're looking into, we started already last year, into the next phase of our growth journey. We believe it will start around 2025, good matching from when water treatment should be finalized. And it starts with the technology and the innovation center for hydrogen. And we will spend a lot of money, invest into facilities, into technology research development projects together with customers, together with institutions, universities, and also within our internal resources to do it. And we signed a letter of intent a couple of weeks ago with a company called RES. They are aiming to build a hydrogen power plant only 25 minutes from where we are located in Ljungaverk. And the letter of intent is about Permascand to be able to set up a commercial test lab where we can run on the hydrogen specification, and we can do our testing with our different technologies and with our different applications, and run and test customers' performance with real data. That is what we're looking for, and that is what we are aiming, because we think that will be very important going on a long time into the future. Let's take the next one. This is the market that we're aiming through, and this is also was part of the IPO package. This is why we are focusing on electrification and renewables, invest into this market, because it's going to be a future market for electrochemical components, electrochemical solutions, and it is large scale. If we start with industrial solutions, there normally we are producing hundreds of components. When we're looking into the water treatment sector, we have been producing thousands of components, and then we're looking into electrification and renewables. We're talking about 10,000s to 100,000s of components. So this is where we're aiming, because we are a manufacturing company. I mean, that is what we want to do. And through to be able to deliver good components, we do the R&D, the design, the construction, because then we can give a long lifetime guarantee, and we can also control better the electricity consumption and the reliability for the customers, and give them a good economy of scale. And when it's time for refurbishment aftermarket, we can also control that and ensure that their processes and systems is continuous working, and that they can focus on producing their type of products. Let's take the next one. This was what we presented 2 weeks ago. It is from the last quarter. We started off the strongest quarter in company history, and we had the highest revenue in one single quarter in the first quarter. So we have a really strong start coming out from the backlog execution, coming out from that water treatment, the ballast water treatment, kicked off a little bit earlier, maybe a little bit stronger than we anticipated. We're coming from 2 years of pandemic closed down. It has only been delays, and now it's started to roll a little bit faster in quarter one, and we could also prove that we are able to deliver faster than what was actually the plan from the beginning. We had a strong order backlog. We had good order intake, primarily from industrial solutions. We were awarded a new greenfield plant that came from two different orders, and to a total value of 100 million SEK. We have done a lot of internal upgrades, process development, and we have the automation and robotization now working in a commercial stage, and we are delivering good margins, good gross margin, developing quarter over quarter, and we also have a good drop through down to the last EBIT line through the efficiency, and through that it's scalable, and that we are able to utilize our resources in a very flexible way. And when we're adding revenue, it doesn't mean that the cost is moving in the same direction. Let's see, next one. We have the financial targets and the dividend policy. We haven't changed this since we went to a public company. I mean, we are a growth company. We're expecting midterm growth of 25% per year. The same with the profitability. We have proven that we have a scalable manufacturing place, and that we can deliver revenue and high profitability. The capital structure is that we should have a very solid balance sheet. We are almost having no debt at the moment, so we have a quite good cash flow. We have good cash situation, and that we should keep going forward. We should not exceed 2 times the EBITDA level. maybe for specific reasons temporarily, but over long term, we should continue to have quite low debt and generate cash that we reinvest into our operation. And the dividend policy is supporting that we're using the commercialized markets like industrial solutions and water treatment to reinvest into the next growth train, the electrification and the renewables. And that is from the short-term perspective what we're aiming to do, and that is also how we guide the market going forward. I think it's one more. Summarize it. You heard me already said it. I mean, we are, and it is important for us to be this independent global provider. We do mission critical solutions. It is customer unique products, and we do it for free markets with different segments within the markets, and we are supporting the green transition that is going on and has been going on now for a couple of times. The value proposition we are delivering, I mean, it is the experience of 50 years. We have the know-how, we have the research, we have the proven core technology platform, and we are really investing in building for the future. There's no doubt that the green thinking and to lower the emissions going to happen. So I mean, it is good to be supportive and to be part of that journey and providing with what we know best, which is electrochemical solutions for that. We are continuing to invest. We are continuing to offer a very attractive business model for our customers. There's basically one-stop shop for the components, for the research, for design, for adapting our components, our products to the customer's processes instead of vice versa. And when we're looking into how we have performed over the last periods, I mean, it is a growing business. It is a growing platform of profitability. And we see that the foundation we have built is for strong growth with high profitability going forward. And we do it through automation, and we do it through robotization. And we have several different ways of producing today, and we're also looking into new ways of automating some of our processes and some of our functions going forward. Let's take the last, but not the least. If there's something you are supposed to remember after this call is that we have more than 50 years of experience, and we have only getting started. There's no doubt that we have the future in front of us, and it's not in the back. And we are definitely an enabler of the global green transition, and we are really working hard every day to deliver good quality products that lower energy consumption, that you can recycle. We have very efficient manufacturing of products, and we can redo it over and over and over, and we can reuse a lot of the materials that we have put into place in the beginning. We can do it in the aftermarket, in the service part, and not always replace with new materials. That was it.
Perfect. Thank you, Peter. So the first question is something that you touched upon during the quarterly report. For those who might not have listened in then, but what you highlighted was that you felt that the challenges related to COVID and a bit of hesitancy among customers seems to have at least become less of a headwind. We're now in the end of May. Do you still believe that the kind of factors that have held back demand are now, gradually easing, and that we could expect to see increased activity related to ballast water, for example?
I mean, I would like to choose to answer the questions like this, because we started already, actually before COVID, that we really need to be good at controlling things that we can control. And outside things that are more difficult to control, we need to find ways of getting them closer to us so we can actually control them. So we changed a lot of our processes and way of acting just before actually COVID happened. And we didn't do it because we knew anything about COVID or war or anything like that. But it was a little bit of a self-help to be less independent and to be trying to smooth out some of these delays that happens once in a while. They may happen more often over the last years than in the past. To have more than one supplier for critical materials, to have more than one way of transportation, and so on and so forth. And that has helped us during this period of time. And in particular, it has helped us this year so far. And we kind of left the lean thinking and we went in the other way around and said that we have our order book, we have our backlog, we know what we are trying to win in the future. Let's try to find the common denominator and make sure that we are buying every type of material or need of transport ahead of the game. So we have really stocked up and we have kind of bought most of the transportation that we needed and that we are needing going forward. So from that perspective, it's not that we are foreseeing a major change or a major way for us to not be able to deliver to the customers in the periods that we can look into. And for us, it is basically this year. What's happening after that? I mean, I don't have any other crystal ball than anyone else. It is always a challenge, and it's always hard work that kind of needs to pay off sooner or later. And I think we made smart decisions a couple of years ago that helps us in this situation. But it is a challenging period around both transportation and material supply and pricing and so on and so forth. It will probably not be easier the longer way we go.
And then just the follow-up then, is it something that you're also hearing from your customers that they are in turn looking more optimistically towards, finding time to install things, wanting to order systems and things that have held back the installation pace in the ballast market?
No, we haven't seen it so far. I mean, it has gone in the other way, actually. We see increased activities. We see increased requests for quotation. So that hasn't slowed down or it hasn't kind of changed over this period of time or since it kind of changed in the end of last year. I mean, it's still a high demand. It's still a high kind of activity level in all the markets, and in particular in the electrification and renewables. It doesn't seem to go slower. It actually seems to go a little bit faster, maybe than we thought 6 months ago.
So with that, I think just the final question is that we are hearing a bit more news lately on the EU wanting to ramp up the investment plans in hydrogen. If you could just please remind us which kind of areas you are focusing on when it comes to a green hydrogen value chain, and which type of customers and projects that we should be looking for in terms of hearing what you may have coming up next.
I mean, our place in the value chain is to be a supplier to the OEMs and to the system integrators. So we're not building any factories. We're supporting those who are building the factories with water electrolysis because that is our core technology. So that is our focus area. It hasn't changed just because it's green hydrogen or anything less, because that is our business model. That is the value chain that we are providing. I mean, the latest announcements, I think, has proven that it seems to be going a little bit faster, and they want more to happen in a shorter period of time. Maybe than we thought in the past. And that is, I would say, beneficial for a company like Permascand, because we have developed and have production capacity to produce catalytic coatings, electrodes, and complete electrochemical cells to hydrogen or to industry or to water treatment. And we don't need only one or the other. We're utilizing the competences for all the different fields, and we're utilizing our machinery for both, and we can switch very fast from one to another without downtime or lose flexibility or efficiency in our manufacturing. I think that is a strength that Permascand can bring to the market, because it will be a capacity issue when this kind of commercialization starts, and also if it goes faster. It's not that many players out there that can produce large-scale manufacturing today.
With that, our time is up for this time. Peter, thank you very much for joining us this day, and thank you all of you who have been listening.
Thank you very much.